PhillipCapital 11th Investment Conference. It is my pleasure to see each and every one of you here today virtually. My name is Kevin Chong, and I have been looking forward to this for weeks because this year, PhillipCapital is bringing you the most engaging and, more importantly, most qualified lineup of speakers yet. No matter where you're tuning in from, please make yourselves comfortable because we will begin very, very soon. In the meantime, I have to inform you that your continuous attention will be required across the virtual rooms throughout today's agenda. So, here's one of the most important reminders. In order to be eligible for your accreditation points, whether it is CPE, CPD, or CE, please sign in by 9 a.m. If your friend hasn't come online yet, it's time to maybe give them a call and ask them to wake up and come online. The Securities Commission, FIMM, FPAM, and MFPC have endorsed the accreditation points for this conference, CPE, CPD, or CE. So if you want these points, please find the assessment tab in the lobby, fill it up, and submit it. To ensure the points eligibility, you must log out only at 6 p.m. today. So from the beginning of today's event, you will need to stay logged in this virtual conference, but feel free to use the bathroom or grab some food whenever we have a break. I can actually see that there's over 4,000 people who have registered for this event, so I'm just going to continue by telling you some housekeeping rules. So, in order to win some of the biggest lucky draw items today, you will need to visit as many virtual booths as possible, if not all of them. There is a lucky draw questionnaire that you will have to fill up before 4:30 p.m. The questions range from topics that are discussed today to features of some of our partners' booths. So make sure that you explore as much as possible, answer the questions correctly, and be eligible to win some prizes. Do take note that the agenda for today is available in the main lobby. Besides, the e-booklet is also available for download in the main lobby. In the e-booklet, you'll be able to get more information about our sponsors. So if you face any difficulties or you have any questions at all, feel free to reach out to our friendly representatives from the Information Center. You may chat with them by clicking on the live chat button, and it will route to your WhatsApp. So from there, you can just begin chatting. And I actually think it is time to begin. A very good morning to our distinguished guests, our partners, our sponsors, our industry players, our speaker and panel of experts, ladies and gentlemen. Welcome to the PhillipCapital 11th Investment Conference. My name is Kevin Chong, and it's great to be hosting such a key annual event for the financial services industry. Since we last gathered at the PhillipCapital Conference 2 years ago, I think one or two very big things have happened. The coronavirus pandemic has reached almost every country in the world. It's pretty much the reason that all of us aren't in the same room right now. So, the pandemic disrupted lives across all countries and communities and negatively affected global economic growth last year, beyond anything that we have experienced in nearly a century. Many economies, such as ours, are dealing with the effects of slower global growth. But it's not all gloomy, though. Right now, the global economy is poised to stage the most robust post-recession recovery in over 80 years. Are you prepared for what the markets will bring in the months ahead as the economy recovers in a post-pandemic world? Well, the theme this year is Road to Investment, Turning the Corner. So this event will give you an in-depth insight and unique perspectives about what's happening in the current markets, as well as what is likely to happen next. Our speakers are from award-winning fund houses who have built impressive investing track records and whose views are followed by many over the years. In addition, there will be a forum featuring some of the most brilliant minds in the local financial industry today. So on behalf of PhillipCapital Malaysia, we would like to take this opportunity to thank our exchange partner, Bursa Malaysia Derivatives Berhad, and our sponsors for their participation. Their support is key in making this event happen, and we highly encourage you to check out their virtual booths. It will actually be the way for you to win some prizes at the end of today's conference, and you know it's going to be big. So, to kickstart today's conference, I would now like to invite Mr. Andy Lim, Group Managing Director of PhillipCapital Malaysia, to give the opening speech. Andy.
Thank you, Kevin. A very good morning. Dr. Muhammad Komasif, Chief Executive Officer of Bursa Malaysia Berhad, Chairman of Bursa Malaysia Derivatives Berhad, Mr. Samuel Ho, CEO of Bursa Malaysia Derivatives, distinguished speakers, representatives from our sponsors, fellow business partners, financial planners, distinguished guests, fellow investors, and traders. I bid you a warm welcome to the PhillipCapital 11th Investment Conference 2021. The theme for our conference this year is Road to Investment, Turning the Corner. We have been dealt with a new deck of cards. Just to name a few of them, we have, on one hand, a stubbornly elevated COVID-19 cases, cautious consumer spending, global supply chain disruption, surge in commodity prices that led some to postulate that this is the beginning of at least a decade-long commodity supercycle, and creeping inflation. On the other hand, we have governments across the world doling out tons of cash and ensuring ample liquidity in the markets, improving vaccination rates, opening up of economies, pent-up demand, and the rising assertiveness of Asia in general and China in particular in the global economy. How should we play this hand? Some of you may have noticed that over the years, in every PhillipCapital investment conference, there is always a binoculars in our conference backdrop design. Hope you can spot it in this year's backdrop design too. This binoculars signifies our pledge to curate the content of the conference to provide you a clearer view of the investment landscape, not just where you stand, but more importantly, the path ahead, so that you can better navigate your investment journey going forward. Information revolution. In the advance of mainframe computers in the 1970s to the 1980s, followed by personal computers in the 1990s, and the World Wide Web in the early 1990s, set the world for the internet stage. We had the beginnings of the information revolution, replacing the Industrial Revolution, which began in Britain in the 18th century and lasted for about 200 years. In the last 2 years, the COVID-19 pandemic accelerated this information revolution in terms of the speed of technological adoption in the global economic and social spheres. It drove major consumer shift from retail and physical point of sales to e-commerce and omni-channel purchasing. While many businesses suffered during this lockdown, the Department of Statistics Malaysia reported that in 2020, income for e-commerce recorded an increase of 32.7% compared to 2019. In the first quarter of 2021, income of e-commerce recorded increase of another 30% year on year. Good companies learn to pivot quickly. As a result, those that spotted and ride on this information revolution trend do not just survive, they evolve and thrive. It is also paramount to be riding on a winning strategy to strive. And this is the theme of the first of our 3 breakout rooms. On the second breakout room, it is called the Return of Asia. Asia is in the middle of a historical transformation. A study by Asian Development Bank asserts that if it continues to follow its recent trajectory, by 2050, its per capita income could rise 6-fold in purchasing power parity terms to reach Europe's levels today. This would further imply that Asia will about double its share of global domestic product, the GDP, to 52% by 2050. Asia would regain the dominant economic position it held some 300 years ago. And that was before the Industrial Revolution. During that era, Asia contributed more than half of the global GDP. In the immediate investment horizon, do we see money flowing back to parts of Asia too? Breakout room number 3 is titled In Search of Alternatives. As COVID-19 pandemic is expected to become endemic, like the dengue, a disease outbreak that is consistently present, we will need to learn to adapt to this new normal and perhaps look for alternatives beyond what we are comfortable and accustomed to. A quote by Charles Darwin, a British naturalist: "It is not the strongest of the species that survives, nor the most intelligent. It is the one most adaptable to change." I applaud you for your presence here today, attending this 8 to 9 hours of full-day virtual conference on a Saturday, as it is evidence of each and every one of you embracing this new normal. Thank you for being part of this wonderful virtual gathering. Phillip Futures in April this year was awarded 3 Bursa Excellence Awards by Bursa Malaysia Derivatives Exchange in recognition for its business contribution in the various segments of the derivatives industries. The awards are first runner-up of Best Overall Derivatives Trading Participant, first runner-up of Best Retail Derivatives Trading Participant, and last but not least, first runner-up for Best Institution Derivatives Trading Participants. I would like to take this opportunity to thank our clients, who many are here today, for your support over the years in helping us achieve this recognition from the industry. Other than attending the talks and the forum, and I encourage you to visit all our virtual booths during the breaks. We hope you'll be able to discover the profit opportunities in your investment journey as we turn the corner. On behalf of PhillipCapital, I would like to thank our generous sponsors for their continuous support towards our effort in providing quality investors education to the investing community. Please join me in showing them our appreciation, especially to Bursa Malaysia, who has been our exchange partner since 2011. I would also like to take this opportunity to thank our special guest, Datuk Muhammad Umar Swift, for gracing our conference, and our distinguished speakers and business partners for their support. This event will not be possible without the hard work and dedication of our organizing committee and fellow colleagues. I would like to record my appreciation to our conference organizing committee chairperson, Jia Ling, the committee advisors, Alfred and Hafiz, and the organizing committee, who painstakingly work to improve on every aspect of this event year on year to ensure that it is informative, fun, and enjoyable for you. Thank you. Last but not least, a big thank you to all of you for taking your precious time to join us this Saturday. I wish you a fruitful and happy Saturday and a prosperous investment journey for the rest of 2021 and 2022. Thank you. Back to you, Kevin. Sorry, we can't hear you, Kevin.
Hello.
Yes, now it's good.
Hi, thank you so much. Thank you very much for Mr. Andy for that opening speech. I really appreciate it. And you definitely kickstarted today's events. And now on to the keynote address, ladies and gentlemen. Our special guest for today is very interesting because he is the only non-Malaysian to run a government agency. He led the team that achieved record results at Bursa Malaysia for the financial year of 2020, as well as the first half of 2021. So he has a varied background beginning in Price Waterhouse, Melbourne, and was then entrusted to build a gas network in the Peninsula Malaysia. He's no stranger to the financial industry as he has successfully led teams in insurance, banking, and takaful. Today, he has over 25 years of outstanding experience when it comes to finance and economics. He leads the exchange to fulfill its vision of becoming ASEAN's leading sustainable and globally connected marketplace. So we're thrilled to have him as our keynote speaker this morning. Please help me welcome to the virtual stage the CEO of Bursa Malaysia, Datuk Umar Swift.
Mr. Andy Lim, Group Managing Director, PhillipCapital Malaysia. Mr. Lam Chu Jin, Executive Director, Phillip Futures, Sdn Bhd. Distinguished panel of speakers and delegates, members of the media, ladies and gentlemen. A very good morning to all. Let me begin by thanking PhillipCapital for inviting me to deliver the keynote address. Bursa Malaysia Derivatives is delighted to return as the exchange partner of the PhillipCapital 11th Annual Investment Conference 2021. Ladies and gentlemen, the COVID-19 pandemic has affected the global economy in three main ways. It has directly affected production and demand, created disruptions to the supply chain and market, and caused financial impact on firms and financial markets. Trying to predict the long-term impact of COVID-19 on businesses and economic activity has become increasingly challenging. In a highly volatile environment, it is critical for businesses to consider implementing a more robust price risk management strategy to mitigate against fluctuating commodity prices while remaining competitive. Looking ahead to 2022, market participants need to be prepared to take advantage of heightened price volatility arising from uncertain economic recovery, potential changes to global trade policy, and increasingly unpredictable weather conditions. Ladies and gentlemen, in times of market volatility, exchange-traded derivatives may be used to mitigate risk by both producers and consumers of commodities, while also preserving portfolio values. Bursa Malaysia Derivatives, in particular, saw resilient performance in 2020, with a total trading volume of 18.2 million contracts, a 35% increase from the previous year. We also set 18 new historical trading volume records, signifying rising investor confidence in the exchange. More recently, we recorded approximately 9.6 million total contracts traded during the first half of 2021. The overall monthly trading volume for FCPO also reached an all-time high of 1.7 million contracts in June 2021, which is equivalent to 42.6 million metric tons of crude palm oil traded. This is higher than the previous high of 1.66 million contracts traded in March of 2020. Going forward, we see the derivatives market as a strong growth catalyst for Bursa Malaysia, as participation has increased significantly since 2019. Ladies and gentlemen, notwithstanding the success that the exchange had enjoyed in 2020 and in the first half of 2021, we are looking to further expand the market. To ensure a sustainable marketplace for the long term, Bursa Malaysia continues to enhance product development to meet evolving investor needs. Among the initiatives undertaken by the exchange to strengthen our position as a global centre for palm oil price discovery in 2021 include introducing the revamped crude palm kernel oil futures, FPKO, on March the 8th, 2021, which serves as a tool for lauric oil industry players to hedge their portfolio risk and enable transparent price discovery for palm oil market participants. Implementation of the Malaysian Sustainable Palm Oil Certification requirement for physical delivery of the crude palm oil futures, FCPO, from 1st April. This is part of Bursa Malaysia's derivatives efforts to foster sustainable development through its product offerings, and the upcoming launch of East Malaysia crude palm oil futures will serve as an effective hedging instrument for East Malaysian palm oil industry players, which accounts for 45% of Malaysia's total crude palm oil production. This will also improve transparency in the East Malaysian palm oil market and attract new market participants. In addition, we launched the FM70 trading competition, which ran from December 14, 2020 to June 30, 2021. The goal of this competition was to encourage investors to diversify their portfolios using FM70, which among other things allows them to obtain exposure to all 70 constituents of the FBM mid 70 with a single futures contract. We were therefore very pleased to recognize the top traders of the recently revamped Mini FTSE Bursa Malaysia mid 70 index futures contract. The derivatives trading simulator, a virtual trading platform that simulates live futures markets with real-time data, has also gone live on March 15, 2021. It is an excellent learning tool available on Bursa Marketplace for new traders to practice derivatives trading and test out methods without putting their money at risk, allowing them to gain confidence in the real market. Above all of these, as part of our ecosystem enhancement strategy, the exchange intends to launch the T+1 night trading session by the fourth quarter of this year. The T+1 night trading is a significant step that will align us with global market practices, as it provides a window into the opening of the US market and the closing of the European market. One significant advantage of night trading is that it will allow retail investors to react quickly and expediently to price volatility on market news in order to protect their trade positions. We believe night trading is a necessary enhancement to further deepen and internationalize our market. Moving forward, we will continue to pursue prospects that will provide more options to investors and traders on Bursa Malaysia derivatives, reflecting our mission to create opportunities and grow value. With the rapid market change brought about by COVID-19 pandemic, it is critical for all of us to stay up to date on the latest developments in the capital market. Financial literacy, continually educate and empower investors, act and proactive in their investment decisions in order to achieve greater financial freedom and wealth creation. Therefore, and in closing, allow me to express our sincere thanks and appreciation to the PhillipCapital Group for providing this opportunity for us to communicate with the market participants and keep investors abreast of investing strategies and market developments. With that, I would like to wish everyone a productive and impactful conference. Thank you.
Hello. Hi. Thank you so very much to Datuk Umar Swift. And now, let me just check if my audio is all right. Perfect. Thank you so much, Datuk Umar Swift. And now we would like to extend our appreciation to the contributors of the PhillipCapital 11th Investment Conference. We would like to thank our exchange partner, Bursa Malaysia Derivatives Berhad. Our platinum sponsors, Eastspring Investments Berhad, Kenanga Investors Berhad. Our gold sponsors, Afin Huang Asset Management Berhad, Am Funds Management Berhad, Maybank Asset Management Sendran Berhad, Nomura Asset Management Malaysia Sendran Berhad, FEM Asset Management Sendran Berhad, Principal Asset Management Sendran Berhad, RHB Asset Management Sendran Berhad, UOB Asset Management Malaysia, 8VI Malaysia Sendran Berhad. And of course, we have our silver sponsors, AIA Pension and Asset Management Sendran Berhad, Baysmart Capital Ventures Sendran Berhad, Opus Asset Management Sendran Berhad, PMB Investment Berhad, the Archipelago Group. Thank you so much to all of our sponsors. And now we would like to take the opportunity to show our appreciation for our distinguished speakers, forum moderator, and panelists. Mr. Ang Kok Heng, Chief Investment Officer from PhillipCapital Management Sendran Berhad. Mr. David Ng, Propriety Trader from Iceberg X Sendran Berhad. Mr. Tan Ming Han, Head of Investments from Eastspring Alwara Investments Berhad. Mr. Christopher Kok King Thai, Head of Equities for Investment from Kenanga Investors Berhad. Mr. Hisham Hamza, Portfolio Manager from Nomura Asset Management Malaysia Sendran Berhad. Ms. Yvonne Tan Hong Yin, Head of Equity from Eastspring Investments Berhad. Ms. Zhang Yuzheng, Portfolio Manager from Principal Asset Management Singapore Private Limited by Principal Asset Management Berhad. Mr. Jonathan Yeo, Analyst from Principal Asset Management Singapore Private Limited by Principal Asset Management Berhad. Mr. Belkaizi Taufik, Head of Investment Specialist and Project Management Office from Maybank Asset Management, Sendran Berhad. Mr. Edwin Lee Kid, Chief Marketing Officer from UOB Asset Management Malaysia Berhad. Ms. Selina Yong, Vice President of Equities from Aminvest. Mr. Alex Ng, Master Speaker and Trainer from 8VI Malaysia Sendran Berhad. Mr. Lau Yu Huan, Senior Portfolio Manager from Nico Asset Management Asia Limited in affiliation with Afin Huang Asset Management Berhad. Mr. Ryan Long Hian Yi, Head of Commodity from Bursa Malaysia Derivatives. Mr. Ong Soon Chong, Portfolio Manager for Investment from Kenanga Investors Berhad. Ms. Dr. Tan Chong Koi, Founder and Chief Strategist of FEM Asset Management Sendran Berhad. Mr. Alex Chong, Director for Wholesale and Distribution in Southeast Asia from Columbia Threadneedle Investments in partnership with RHB Asset Management Sendran Berhad. Mr. Pua Lee Kirk, Chief Strategist and Executive Director from Phillip Research Sendran Berhad. Mr. Muhammad Salim Kadir Bakas, Executive Vice President from Bursa Malaysia Derivatives Berhad. Ms. Joy Marina Chong, Head of Fixed Income for Investments from Kenanga Investors Berhad. Thank you so much. And now, ladies and gentlemen, on to our first speaker this morning. Again, we would like to very, very much appreciate all of our partners, our sponsors, our speakers, our panel of experts, our moderator for this morning. We are truly excited to have you here. Our first speaker for today, Mr. Ang Kok Heng, joined PhillipCapital Group in January 2007 as the Chief Investment Officer. He brings along with him more than 20 years of experience in equity research and investment, having worked in TA Securities as the head of research for 7 years, and thereafter as the head of investment in TA Asset Management for another 12 years. He has very extensive experience in the capital market in Malaysia, and his views are well sought after by local and foreign journalists. He was an investment columnist for New Straits Times for 3 years, and he also acted as the investment consultant for a medium-sized composite insurance company for several years. While in his previous employment, he led a team of fund managers to win several awards for the unit trust funds. And now, here to talk to us about the forces behind share price movement, Mr. Ang, the screen is yours.
Good morning. Thank you for signing in and participating in the Phillip Investment Conference. As you know, the market forces is always there in the market. Those in the investing in the stock market sometimes wonder why a particular share go up or come down. Stock market is an arena for the bull and bear. There are many participants in the market, including investors, traders, speculators, hedgers, arbitragers. There are long-term investment based on fundamental. There are also short-term trading on news flow. We have a local institution, foreign institutions, and retail investors participating in the market. Basically, there are several the main reasons why the market moved. I summarize it as an economic outlook, political stability, corporate earnings growth, interest rate, perceived risks, expected returns, and speculations. These are the main reasons why a particular share move or a particular market move. Of course, there are also many other reasons which I will also touch on at the end of my presentation. Market is a byproduct of the economy. So when the economy do well, you expect market to also perform well, right? Because when the economy do well, what is full screen? Where is full screen? What is full screen? Can I share full screen? I don't know where presentation, yeah. Okay, let me continue because you are asked to show the full screen. As I mentioned, the economy is the most important thing that drives the market. So when economy do well, there are more opportunities and company will do well. There'll be better earnings. And at the same time, there'll be more saving among the individual, among funds. So with more saving means that there are more money, more fund available for investment. Right? At the same time, when the economy do well, there will be more the IPO listing. There will be more corporate exercise. So that will also provide a lot of opportunity and excitement to the market. And when all these corporate exercises happening in the market, then the whole market will be very buoyant. People will feel good about the market. So that one lead to the other. That will also drive the market even better. Political stability is also very important. Or political instability is added additional risk to the market. Market don't like uncertainty, especially the institution investor. Foreign investor got many choices. They can come to country A or country B. So not necessarily they must invest or forced to invest in a particular market or country. right? They got tries to move to another place. So whenever the country got not so good political stability, then they will tend to underweight and move the money to another place whereby it provides better opportunity. Unlike Malaysian, maybe we are literally stuck here in our money. So we are either invest or not invest. Right? So that probably is one of the reasons why the recent political instability has also driven away these equity investors to other places, and that caused our market to be weak. On the other hand, if the political infighting within some of the political party, that will not affect the government policy, then the investor may just ignore it. That happened in the past when there are some internal politicking within the Barisan Nasional, either UMNO or MCA. Right? As long as the government stay, the policy stay. So investors are not too very concerned. They know all these are temporary, right? So you have to look at whether the political instability is the whole country or temporary internal issue, right? Whenever there is this political instability, there will be a concern about this policy continuity. That is the main factor, main reason why the foreigners do not like political instability. When there are changes, too many changes of the top government servant or politician, or including minister, then there will be a delay in the approval process and also delay in the execution. A lot of projects may be put on hold, not certain whether the new minister will change anything. So that affect the implementation of project and also the growth of economy. Political link stock are also in limbo. So whenever there's a new politician come in, some of the political link stock may be in favor and some may go down. Right? So it may happen. We've seen this recently, when there are talk of a change of a government. So some of the stock went up, some of the stock went down. Of course, in Malaysia now, political link stock are not as rampant as in the past. One major concern is that there's also no clear majority within the government. Either we are hung government, unstable government, or weak government. I think presently we are facing is a weak government whereby there's no very obvious majority. Strong government will have a two-third majority, but not presently. So a lot of things are not able to execute it because there's no commitment, no determination to push through some of the reform. Fundamentals, of course, is one of the key factors driving the economy. Investors invest based on fundamental, right? And normally, a stock that have a high growth in earnings will also trade at a higher valuation. That means a higher PE. However, the growth stock may also have a higher risk, as earning growth may disappoint, right? So the stock may be very volatile when the profit missed the market expectation. So this is one of the challenge of investing in growth stock, especially now, like this stock in the tech sector now are trading a very high valuation both in Malaysia and worldwide. So when the expectation is not there, earning is lower than expected, then the share price may drop more sharply than other stocks. The earning growth can also come from several areas such as organic growth, whereby company grow its business, grow its the original business, or through diversification into other businesses, having another growth engine, or by way of acquisition, right? Different company or different management style. Some prefer to grow their business gradually. Some prefer to grow through acquisition, which can be faster. Whenever investor invest, they're looking for the future value, and assuming that the future value can be determined, right? And the value of a stock is the net present value or the future cash flow, right? There is a shown here, net future value of net present value of future cash flow, and it can summarize as the future dividend per share or earning per share divided by required return minus growth. So the higher this required return, then the lower the valuation, right? And the higher the growth, then the higher will be the valuation, right? It goes that way, right? So when interest rate is low, like present moment, people expectation will not be so high, right? Some people say 8% return will be sufficient. So that will drive up valuation. And that is probably one of the main reasons why the worldwide stock market is trading at a very high valuation. assuming that growth remain the same. Assuming that the interest rate is at 20% growth, then the required return will be more than 20%, right? And with the kind of expected return, then the stock cannot trade at a high valuation. We're just taking an extreme example. And a company with a higher valuation means that investors are willing to pay a high price for it. Now we look at the market it is very much influenced by the interest rate, right? Which is one of the major factors that affecting the market direction. Just now we look at the stock market, this interest rate at the stock level. Now we look at interest rate at the broad market level. Right? So the interest rate is very sensitive in developed market such as US. It has a very strong influence on the asset allocation between the equity and bonds. And the shares which are more sensitive to interest rate fluctuation are including banks, credit providers like microfinancing, auto-related stocks, right? Property stock, which are very much influenced by the ability of this purchaser to finance and the installment that they need to pay, and also highly geared stock, right? If the interest rate go up, then the earning may be affected. Right? Interest rate normally go up when the economy is too strong, right? So here's one of the factor that drive the economy. Stock market may take a correction when the interest rate started to go up, right? When the economy is good, normally stock market is better, as I mentioned. But the economy is too strong, whereby interest rate forced to increase, then stock market may take correction. That's is something that we are waiting when the Fed going to increase interest rate. The Fed is also very good at manipulating this federal fund rate to balance the economy. Economy too strong, then they increase interest rate. Economy weak, they reduce interest rate aggressively. Perception is also very important in reality, and perception is probably more important than the fundamental events. Perception is opinion that in the mind of investor, and that is the one that determines whether investor should buy or sell. A complex issue that cannot be quantified, perception has to come in, or perception come in because the future data is very difficult to estimate. So the people have to depend on this guesstimate on how to view everything. Some of the factors that are being perceived are political outlook, right? Either globally or even Malaysia. Now, what will be this political direction like in Malaysia over the next 6 months or 1 year before the next election? And the trade war between US and China, how we end up with this is also a very complex issue. And the ability of US to manage its bloated economy. If so much QE that they are going on and so much money being printed in US, eventually the US has to unwind all this additional loan. That in other countries that the government print additional money to sustain the economy. And the extent of China in the regulatory reform recently is also causing China that is the new trend. Some facility is temporary. The next one is the expectation. Expectations slightly different from perception in the sense that expectation is something that you can have data to measure, right? And when the expectation of a better economy, it will drive the market. Not waiting for the economy to shown better, but the expectation is the one ahead of what is going to happen. Market events must meet the expectation of the investor. So that is very important, right? If a company reported higher earnings, but it was below market expectation, then the share price may even fall. Sometimes investors wondering how come this company has a now better result, why the share price fall, right? On the other hand, if earnings does not fall as much of market expectation, the share price may even go up. So you always heard that the earning is better than expected, right? And the expected earnings can be on company level. A lot of fund houses have their own expectation. It can even be the market consensus level, which is basically available in Bloomberg, giving you a summary of what the market expect the earning to be. For example, we can see that in the case of Top Glove, right, the share price peaked in August and subsequently in October. But on the other hand, the earnings continue to go up, right? Continue to go up. So, even though the share price has started to come down at the second peak of October, right, all the way. Earnings go up is because of the average selling price of the rubber glove was getting higher and higher. There's a time lag effect. But the share price coming down was because of people expecting this average selling price of rubber glove is temporary and eventually it had to come down, right? So that expectation drive the share price. Sorry, wait for a while. Okay. Next one is that speculation. Can you take out of this? Okay. Speculation is also a very important thing happening in the market. The market will be half dead if there's no certain amount of speculation. A buoyant market must have underlying speculation so that it provides liquidity to the market. A good example is that in the futures market, whereby it's set up or designed for hedging purposes, but without speculation, there will not be sufficient liquidity to conduct any hedging, right? So speculations play an important role to let the market find its fair valuation. So on one hand, you do not want market to be too speculative. On the other hand, you also should allow some speculation to make the market more efficient. And speculation is normally done by retail investors, right? The participation can be also from the hedger, day traders, which Malaysia also we also approve day traders. Also, we have proprietary traders, whereby they may have limited this capital, but they can trade in the big way. Okay. As you know, our market bottom in March last year, and there are also many people make money from investing in the rubber glove stock. For example, Top Glove that went up 5 times from February last year, before the pandemic, and to August 2020, right? So there's a time when during the lockdown, a lot of people stay at home and have not much thing to do. So going to the stock market become one of the pastime, right? And it happens that they're coming to the market at the bottom. So they make a lot of money. But on the other hand, you can see that some of the penny stock have done also very well for the last 1 year until August this year. For example, GET Global up 23 times, Genetic Technology up 14 times, Solution up 4 times, and up 8 times, etc. So these are some of the example of the speculative stock that cause the market to be buoyant. But coming back to other than this few main factors that we mentioned, there are also the other invisible hands in the market. What we have summarized here are investment that help under nominees for special purposes, investment held through proxy, investment held through related parties. Some of this trading, you do not know the objective, right? And also do not know who are the real person behind it, because some of them could be under margin account, etc. Right? The share price can also move because of corporate exercise. Some of this corporate exercise could be sensitive, some could be less sensitive, right? So whenever the share price move, there must be some reason why it happened, right? You can say that it could be an insider, but it may not be exactly insider. It could be something happening that people are speculating on it. People are guessing or expecting something big happening, so the share price moves. So some of these are the one that cause the fluctuation in the market. Stock can also go up because of promotion through certain roadshow. That is happening normally among this institution investor. That a particular broker started to cover a stock, started to promote a stock, started to do roadshow. That caused more demand for the stock, and the stock price go up. Right. So this is some of the reason why this share price suddenly become active and turn alive. Right. Every day, before we trade, we have to look at what happened to the US market, right? And at the same time, we can also look at the US Dow Jones future, for example. So to find out what is the direction of the flow of money. There's also one Morgan Stanley ETF listed mentioned shares ETF listed in US that can also give the direction of the market, where is it heading, right? So these are some of the things that we look at before we start the day, right? And also some of the Asian market has started before us now, like Japan, Australia, they started earlier. So it also can give indication before we start trading at 9 o'clock to determine what should we do now for the day, right? So some of these are leading indicator that determine what type of strategy should we adopt. Right? On the market, when market trading, this we can continue to monitor the Asian market movement, right? At the same time, you can also monitor Malaysian KLCI direction. Where is it getting stronger or getting weaker? KLCI future can also be an indicator to find out what is the expectation of other people about Malaysian market. But KLCI is getting a bit less effective recently because it's not so buoyant anymore. So the KLCI in future may not be as good indicator as KLCI itself. So all this will help investors to determine what the action should you do. Should you be more aggressive in your buying or selling? Right? So all this helps in our this trading process. The second one is that there are also other factors that cause the market to move, like the private placement. Right? A private placement normally at a discount, not more than 10% discount. Right? And this private placement can be a big amount. Sometimes it's given up to 30%, 20%, but normally it's not more than 10%, right? And these have been approved by shareholders and Bursa, and the quantum of it actually have a strong impact on the share price because they are placed out at the discount. It must also determine whether who are they placing to, right? To institutions or to this private investors. So sometimes you find out the share price drop because of placement at discount coming to the market. Even the announcement itself can also cause the share price to come down because people worry about this new supply may drive down the share price. But for long-term investor, of course, it doesn't affect their decision making on the buying those shares. So this one something that you have to also monitor. And upon listing of this private placement share, and also upon listing of the right issue share, which is normally a discount, can also drive down the share price temporarily, right? That happens very often. So if you're wondering how come a particular share price come down for no reason, it could be one of them, right? Private placement and right issue. The next one is margin financing, right? There are people still borrowing from banks, more from banks and some from stockbroking firm, right? And margin financing is the one that allow people to leverage up to buy more shares. But on the other hand, if the share price come down, this type of shares or margin shares can be what they call that under forced selling. So that is also something to look out for. Then we have things like share approved list stock, a stock put into this KLCI or MSCI, that also affect the price of the movement. The other minor factor will be the company going to make from A's to main board when the stock been approved to be in the stock universe for a big institution. That may also influence the share price. There's another one I want to touch on is ESG. ESG is a new type of stock that more money is going to be allocated for this. And eventually you find that this stock will trade with a better valuation, right? So the shift to ESG stock is something that's unavoidable. So even in Malaysia, you also have a non-ESG compliant stock that, especially those in plantation sector, like Tenaga, they're trading at discount because they are perceived to be non-ESG, right? Although the ESG is not fully implemented in Malaysia, Bursa already launched the FTSE for good BM index and also BM Sharia index. There are 76 stock in that index, out of which 54 are under the Sharia compliance. And we also exploring the possibility of having ESG mandates in the future. When we're ready, then we will inform our investor. If a stock under some of these are still under the ESG stock for conventional, 76 of them. The market share is not small, 943 billion. And financial sector is the one that account for about 1/3 of the total market cap of the ESG stock, right? So having said all this, then you'll be wondering that a lot of homework need to be done before you invest. Correct? As a fund manager, we have to do a lot of homework to get as much information as possible. So whatever we did, basically reflected in our investment. So if you do not know what fund to buy, now let me introduce our flagship fund. This is our only equity fund. Only equity fund in PhillipCapital before we took over other funds from this Pacific Mutuals. This fund has performed very well over the years. We're not choosing the best fund to show it to you. This is the only flagship fund we have. We have performed 10.7% compound return since inception, right? And we incorporated some of our knowledge and our understanding of market forces that influence the stock market. Thank you. This is my last piece of presentation. Understand there's some question here. Am I going to sum up? Let me pick up one question.
Yes, there is, Mr. Ang. There is, if you take a look at the main screen right now, you'll notice something called join the Q&A session at slido.com. Now, for those of our friends who are participating in today's conference, after every talk, you will have an option to head on over to slido.com, or even during, head on over to slido.com and put in the room code, which is PIC21. PIC21, and you will be able to ask some questions to our speakers. Mr. Ang gave a 40-minute presentation earlier, and now some of our friends have already found out on slido.com that they have a couple of questions that we want to ask you. Mr. Ang, do you have a preference on which question you would like to answer first?
I don't know. I saw the first question.
Okay.
What are the strategies to select a good fund or investment, regardless the market is good or bad? I think when people ask me what is the best share to buy, I would say I think investors are basically expecting what sector am I prefer. Basically, I tell them best share to buy is the share that have a good management, right? Because they are the one that going to handle all the business problem, take out all the opportunities. So a good fund to buy are the one that's a good fund manager, right? So you don't need to worry too much about the challenges that they're going to face.
All right. Well, I think a lot of people are now asking you see, you can actually vote for the questions you want Mr. Ang to answer. And one of the anonymous questions was, recent years, some stocks with good earnings are moving downhill, but loss-making stocks are going up. What do you think the major forces are when it comes to driving this kind of behavior?
Of course, good earnings may be below expectation, or could be that good earnings like a glove stock having good earnings, but people expect this is temporary. So that may be some of the reason that cause the price to go down. Loss-making company, the share price go up could be due to the expectation of the other thing that coming in, or new shareholder, whatever. So there are many reasons that may drive the share price.
Okay. I think we have two more questions, so let's just cap it at these two questions. I believe that after every speaker, you guys can still ask questions. Just head on over to slido.com and key in the room code. For now, Mr. Ang, I would like to ask you, with market, I think Philip Tay asked this question, market discounts everything, including all that you have mentioned, namely fundamental, political, and psychological. So as the CFO, how would you react to the changes in the prices?
This is a very broad question. That if market efficient, if in the efficient markets, share price reflect everything, like you said, no. But I don't think market is really efficient, right? Because a lot of investors are not well informed. They're, for example, sentiment driven, so they are not fundamentally driven. So if a market is fundamentally driven, then the market will be more efficient. But which is not possible because a lot of investors are very emotional, right? So there are many types of stock. For us, we will not participate in those on the speculation part. We are basically going for the fundamental. Of course, fundamental could be affected by political changes, etc.
And Chris Chiu asked this question. I think it's gotten 9 votes so far. So let's throw in one more question. Chris asked, what is your view of robo-advisors and their impact on the investing community?
I look at robo-advisor as one alternative, right? So even for fund manager, every fund manager use different style to invest. Some look at longer term, some look at the shorter term, some look at this cash flow, some look at the gearing, management, and etc. So the emphasis are different. So robo-advisor emphasis will be less emotional, and also this more structured. So it is an alternative investment. So you will not have a risk of this fund manager affected by market sentiment.
Mm-hmm. And I think one of the let's ask the final question here. Yeah. Hafiz asked this one. He said, despite people expecting glove prices to be lowered in the future, pushing down the share prices for Top Glove, for example, US has recently revoked the import ban. What do you think the future outlook is going to be?
I think the future outlook for this glove stock are basically whether people are still using glove. So that is definitely positive for the outlook long term. But having said that, there are also a lot of new supply coming in because of this good selling price, especially from China. So that will be kind of a challenge on the future, whereby even though demand can be stronger, but at the same time supply also very strong. So that could be another reason why the share price of rubber glove stock like Top Glove is weak at the present moment.
All right then. Do we have Mr. Ang? Thank you so much for joining us here today. I think we have so many people are really wonderful. They're asking you a lot of questions, but I actually think that if we're in the main hall, we will be able to interact with one another a lot easier. Mr. Ang, we have come to the end of the program for your speech and your Q&A session, but I thank you so much for telling us about the forces behind the share price movement today.
Thank you very much.
All right. And now our next speaker is Mr. David Ng. He's actually currently a full-time proprietary trader with Iceberg X Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. He has had extensive research and is actually very well versed in the commodities and indices markets. He currently trades the Malaysia Index and crude palm oil futures market. Previously, he has led a team of young and dynamic his teammates to promote futures and derivatives instruments to the Malaysian public with a prominent local broker. He conducts regular public seminars and also seminars on topics relating to future tradings and has helped individuals to start their trading journey. In addition, he has also provided frequent market commentaries to local media like The Star, Business Times, and The Edge in his role. So, asking the questions about commodities, super cycle, or temporary blip, here's a look into the palm oil market with Mr. David Ng. Hi, David.
Hi, Kevin. Thank you for the kind introduction. I'm just going to share my screen. Yeah. Okay. Just before I start, just like to extend a very warm, heartiest appreciation to PhillipCapital Group as well as Bursa Malaysia for the kind invitation to be able to speak on this platform, especially on the views regarding commodities, whether are we in a super cycle or temporary blip. Probably have heard super cycle has been always a buzzword of late, especially you look at certain classes of commodities. We have indeed seen prices at record levels. Case in point, you just look at the Malaysia palm oil market on the Bursa Malaysia Index itself is actually broke a record high just early part of this month. So I think the question is very paramount at this critical juncture, whether are we going to see prices to be elevated going forward? So it's important for us to assess some of the key dynamics that could actually impact prices going forward, especially in relation to the palm oil market. Just a very quick disclaimer. I think any views presented here is purely based on my personal opinion. It doesn't reflect any opinion by the exchange or even by PhillipCapital Group itself. And obviously, I think dabbling in derivatives is highly leveraged, highly risky. So please do consult your licensed advisor for the next course of action. Now, in this chart we have is the Thomson Reuters Commodity Index, which measures or which tracks the index prices for a lot of major commodity asset classes. Be it whether it's in the energy space, the agriculture space, or even in precious metal. So if you just look at the past 20 years data, you can clearly see that the price chart itself, back in the early 200 year, we can clearly see that China has actually rise on a very rapid economic growth, and that actually caused a boom in commodity demand. But that took a turn when GFC hit us, global financial crisis hit us back in early 2008, and we saw commodities slump, and we saw prices across the board reaches to bottom low. If you just look at crude oil, it went from as high as 70 to as low as $20 per barrel. And it took a while after the GFC to really recover in terms of commodity prices. And I think for the past decade, after 2010, we saw that prices tend to be on a sideways market. Commodities as a whole is a very underappreciated asset class. And with such a low price for many years, it does involve a low investment in this space. So therefore, we see years of underinvestment. We saw infrastructure that's actually quite bad in certain commodity classes. So that actually resulted in lower prices for pretty much quite a long term. Now, then came 2020, the year of COVID pandemic. So for the first time in history, if you look at crude oil prices, for the first time in history, you actually saw a negative price, which is unprecedented. That thereafter, once vaccination is in play, we start to see economy starts to reopen, commodity starts to regain. So where we are right now, we start to see that the cycle of commodity starts inching higher. It has broke the long-term sideways trend back in the early 2010s. So it's very crucial question that we should ask ourselves is whether can this rally still last? Now, a quick answer to that question is obviously there's certain commodities that is still pretty much have a lot of room to grow, but there's certain commodities that is I would say that the supply is trying to catch up with the demand, and eventually it will catch up with demand. So we can see a diverse performance across some of the asset class, some of the commodity asset classes. Now, when it comes to the topic of commodity super cycle, the word super cycle itself is reference to, as with any other commodities, there's always a cycle in terms of the supply and demand dynamics. There's always will be a period where demand tends to be high, prices tends to be high, and therefore it will result in excessive supply coming on stream in the market, and that will push prices lower. So it's a cycle by itself. Now, super cycle itself is in a sense that if you look at the macro picture, the longer term view, we can clearly see the cycle within itself. If you just look at this chart, we have since the early 1900s, you can clearly see the past 100 probably distinct 4 different type of super cycle that is in play. If you look at oil energy, we have the 1970 boom cycle, and obviously, oil hit as high as $110 back in 2013, and therefore it slumped thereafter because of the increase in shale oil performance. So I think itself, the commodity does display a certain type of super cycle. In fact, now if you just look at not all asset classes in the commodity itself display similar cycle patterns. Energy is very distinct because when you have high energy prices, it always incentivizes producer to always invest to increase supply in the market. Eventually, the supply will catch up, and therefore it will push energy prices lower. Now, it's not very distinct for agriculture or even base metals because investment in these classes requires long-term investments and heavy capex. So that cycle will take a longer period. Now, if you just look at the chart, we can clearly deduce that it probably take about 30 to 40 years for a period of a super cycle. So the recent super cycle that I've seen in commodities, obviously the rise of China back in early 2000. But that cycle was short-lived because we have the GFC. And again, when you look at 2020, we have a pandemic that actually really pushed some of this commodity demand to levels that we have not seen. So really is, if we want to see the next super cycle in any commodities, the question that we need to really be emphasizing is, are we going to see a persistent demand across the board? If the demand is able to persist itself for a period of time, then indeed a commodity super cycle could be in play. Now, just to share with you an overview of some of the key commodities performance. So palm oil itself this year, we have seen a record rise, almost 40% gain on year-to-date basis. Now, surprisingly, if you just look at other commodities, you look at orange juice, you look at sugar, and surprisingly, coffee has actually been a very rapid rise. It's almost 60% up year-to-date. And that's also mainly because we clearly see weather in play, especially in Brazil, which is a very key region in producing coffee. So we just have to be prepared to pay your next cup of Starbucks coffee at a higher price, given that we are going to see higher sugar and higher coffee prices going forward. Now, on the precious metal space, it's slightly different. Obviously, we saw gold prices hitting above the 2,000 per ounce level late last year, given the uncertainty of the pandemic. But thereafter, I think we saw when the economy starts to reopen, when economic growth starts to go on a higher trajectory, we start to see precious metal coming off from the peaks. And energy prices is definitely a recovery theme. We can clearly see from negative 30 last year to where we are right now. WTI is trading about close to $70 per barrel. So it's phenomenal in terms of recovery. But what it goes to show is that, in general, commodity prices will rise going forward, given that, we have a supply shock last year. A lot of economies were shut. So production in a way was, was pretty much shut down. We also have logistical bottleneck. If you just look at those logistic prices to ship shipments from Asia to Europe or even to the parts of US, it actually costs 6 times more compared to last year. So with all this logistical backlog, I think supply will have a crunch, and prices will definitely have to rise with demand going higher forward as the economy starts to reopen. So funny enough, I don't have in this table is that oats. If you just look at oats as a commodity, it indeed hit a record high, I think just early part of this month. So yeah, we just have to be prepared, to pay higher prices, especially for our agricultural produce. And inflation is definitely going to be a recurring thing going forward. Now, interestingly, I'd like to share on this price chart of lumber. Lumber have a meteoric rise early part of this year. As you know, US is a major consumer of lumber contracts. So you can clearly see that the impact of pandemic did resulted in a lot of people staying at home, stuck at home, and a lot of them are involved in a lot of DIY projects, and therefore it actually requires a lot of lumber and wood. But supply was not fast enough to catch up with such a rapid rise, and therefore I think prices reached almost a record level, almost 1,500 per ply. But then again, once supply coming on stream, a lot of sawmills starts to pushing more supply to the market, and economy starts to reopen. The funny thing is that when economy starts to reopen, people no longer find it hopeful to even stay back at home on weekends. They rather to go out, and that actually caused slump in the demand of lumber. So you can clearly see a meteoric rise followed by a meteoric fall. So now this commodity cycle is very evident in a lot of major commodities. The reason being is because when we suffer a supply crunch, really prices will just have to adjust upwards on quite a drastic manner. And with high prices, producers are incentivized to produce more and to release a lot of supply to the market. So clearly, we can clearly see that this could be very evident in certain commodity classes, but not all commodity classes will have such a impact like this. But again, I think we are truly entering a phase of a commodity upcycle. It may not be necessarily a super cycle, but we are definitely looking at a lot of prices to be on an upward trajectory, especially on elevated prices. Now, I think what led to the rise in commodities is obviously the rise in economic growth. So year 2020 was when the COVID hit us hard. Year 2021, this year is probably the year of recovery. We are looking at economies are reopening, vaccination rates are getting higher. So we should see higher growth in terms of economy going forward, and that will create a lot of demand. So that's why commodities in general is in favor. If you just look at CPO itself on Bursa Malaysia derivative, you can clearly see that the prices, we came from as low as 1,800 ringgit per metric ton to as high as 4,500 ringgit per metric ton. And that's a tremendous rally. So, it's moving in line with other commodity asset classes. In fact, I think just a couple of months back, if you just look at comparing with other agriculture products, CPO is continuing to be the top performer in terms of their price gains. So, we are likely to see this scenario, going to be quite persistent in a sense that I think CPO complex itself is suffering from a very supply tight issue right now, and it's going to be, prices is going to be quite elevated for a period of time. Now, so diving deep into crude palm oil market. So if you just look at the vegetable oil market, because crude palm oil itself is a vegetable oil, and just compare with other vegetable oil prices, palm oil is phenomenal in terms of their price. Reason being is because we are really in a tight supply situation. Just early this year, a lot of forecasters were looking at palm oil to hit an all-time high, and indeed it did hit an all-time high. And obviously, there's a lot of numbers throwing around. Whether could we hit the 5,000 ringgit per metric ton mark? Personally, I think that's a very difficult achievement to hit, given that scenarios will change in the coming months. But nevertheless, if you just look at what are the fundamental dynamics that's in play, especially in the vegetable oil space, we clearly see palm oil stocks is relatively very low as compared to other vegetable oil. Consumption took a hit, especially in last year when at the height of the pandemic, but that is set to recover. I think this year, 2021 and 2022, we should see massive recovery, especially in the vegetable oil space. And stocks to use ratio, which is a very good indicator for a lot of observers in the market to really gauge where the situation of the supply is. So we can clearly see that I think palm oil still have a low stocks to use ratio, which indicates that supply and stocks is still very tight and demand is still quite elevated. So the same goes for soybean oil, rapeseed, and even sunflower oil. So again, I think if you notice, you go to the supermarket, vegetable oil prices are actually on the rise. So again, I think that will feed into inflation, and that should be a sign of concern in terms of economic policies going forward. Now, if you just look at CPO itself, production this year has been bad, abysmal. If you just look at January itself, I think January this year we recorded one of the lowest in the past 6 years, and that's actually worrying. So with such a slack of production and production not creeping fast enough, prices would tend to rise. And true enough, we just look at the first half a year output for this year. It was one of the lowest in the past 4 or 5 years. So I think projection this year, total production for Malaysia is likely going to be on the downwards. I personally looking at about 18.4 to 18.5 million tons. Last year we were hitting about 19.1 million tons. So I think that shows how drastic or how critical that situation is, especially when it comes to supply of palm oil in the market. Now, surprisingly, is that yesterday we just had a MPOB official report which published August numbers. August numbers seems to be surprisingly well. We saw a month-to-month increase as I think on a circle of 11%. And that shows that if you just look at the tendencies, seasonal tendencies in the palm oil market, if you notice for the past couple of years, around August and September is usually the period where production tend to pick up. And true enough, I think August confirmed the trend that in the next couple of months, we probably could see production of palm oil to tend to pick up. But what is worrying is that when it comes to November to December, that's where we see the peak in production, and we should see production starts to come down. And that's where, if stocks levels are still relatively very low, that should be a sign of concern. But I think given recent report by MPOB, I think it's quite confirming the trend that we probably are entering into rising production cycle in the palm oil space. Now, if you break down month-to-month change in production, what is interesting to take note is that if you just look at July itself, if historical pattern does display certain tendencies, seasonal tendencies, and we just look at July. This year we're anticipating that July will be a month where you should see production start to rise, but we didn't see that, and that's why it pushed CPO prices to as high as 4,005. Now coming to August, when those numbers was actually reported yesterday, it was a shocker. It will actually turn up to about 12% increase. But what is important to take note is that if you just look at the month itself, we are actually going into a high production cycle in the palm oil market. Going into September and October, we should see higher production month-on-month basis. But important fact is that if you just look at November and December and even January, that's quite interesting. For the past 20 years, we probably have seen that November, December usually are the periods where production tends to go lower month-on-month basis. And that goes to show that we should see price to be supportive towards the year-end period. And crucially to watch is how production is going to play out coming September-October period, because that's where seasonality we are expecting higher production numbers. But crucially, I think year-end is where really production is going to taper off, and that's going to have an impact in terms of the prices. Now, I think several factors actually explain why the sluggishness in production. I think the major reason is obviously Malaysia, parts of Malaysia, especially in the peninsula, as well as certain parts in East Malaysia, has been on the ongoing lockdown period. So key estates, or even oil palm estates are actually being in a lockdown period as well. So that actually affected output. There's certain consensus as well. There's certain market surveys that actually reported the normal harvesting cycle in oil palm estates usually take about 14 days. But there's certain reports that during the lockdown, it actually extend to 30 to even 40 days. And that's actually critical, because as you leave the fruit untapped or unharvested, you tend to have you tend to get fruits that's rotten, and it will definitely affect you eventually. And that's what we are seeing probably in the first half of this year. So I think that's crucial. But obviously, I think with cases looking to moderate, and states are starting to reopen, so harvesting cycle will likely to pick up, and that's going to affect into higher output going forward. So again, I think these are some of the key impacts that's actually trying to explain why the sluggishness in production. Besides that, if you just look at it, this half, I think late last year, we have seen tremendous issues in the palm oil industry, especially when it comes to labor. So again, I think we face a lot of labor shortages in some of the oil palm estates, and that again is also affecting output at the end of the day. So going forward is important on how these scenarios will play out. If we see shortage of labor likely to persist towards the end of the year, and we are not seeing shorter harvesting cycle, again probably we see production to be affected. So I think if you are watching the market, if you are observing prices, it's important for us to take note that how production is going to be affected, how these factors is going to play out in the next coming months. Now, what I have here is basically to chart the MPOB CPO stocks against the BMD Malaysia palm oil price. So you can clearly see that whenever you have a high price environment, stock levels are usually very low. So it's a very inverse relationship. So when you have a high stock levels, you probably will expect prices to be on the lower side. Now, what is critical is that for many years, Malaysia stocks levels is usually above the 2 million tons. That's sort of like the market averages for a long period. So whenever we fall below the 2 million metric ton level, it does indicate the market supply is tight, stock levels are low, and usually prices will have to adjust upwards. So I think that's again another important parameter if you are watching the market, especially in terms of prices. And obviously a low stock price environment is definitely favorable for palm oil prices. And we just look at a trend of stock levels. Clearly, I think 2021 is where we are seeing for quite a long time levels of stock levels in Malaysia, doing below the 2 million ton for a period of time. And again, surprisingly, just yesterday, MPOB official report for August numbers, it showed a 25% increase month-on-month basis. So again, that actually points to, as we enter into high production cycle, we should be seeing higher stock numbers, and that could affect prices going forward. But importantly, if you just look at, again, November, December, and even January next year, seasonality points we should see stock numbers start to decline due to lower production numbers. Now, on a month-to-month basis, surprisingly, I think July was a surprise. We are down 7%. That's why prices tend to rise in the August period. But yesterday numbers, if you just were watching the market, market was down by 100 over ringgit. And that's also mainly attributed to higher stock numbers. Month-on-month basis, we're up 25%. So I think it's crucial to watch what September, October's numbers are, because that will really paint on how prices might go forward in the next few quarters. Now, what I compare here is basically to look into the Peninsular Malaysia price as well as East Malaysia price for the palm oil prices. what is evident is that if you just look at East Malaysia prices, it's always trading at a discount compared to Peninsular Malaysia prices. I think, being in a trading community, I think is very vital that Bursa Malaysia derivative finally going to be launching the new East Malaysia palm oil contract. And if you are a miller or even a plantation owner in East Malaysia, you have a direct contract for you to hedge. Given that East Malaysia, in terms of production, it covers roughly 50% of the total Malaysia production. It is very important in the supply dynamics. So with a new contract on board, hopefully we are able to gauge or even to determine where prices are going to be, and it gives a better hedging mechanism going forward. So I think we in the trading community is actually quite excited with the new launch of this contract. Hopefully you'll create more dynamics as for the palm oil complex as a whole. Now, when it comes to export, despite low stocks level, low production, exports has also not been performing very well. If you just look at numbers this year, it has been quite sluggish. Despite we are seeing economy around the world is starting to reopen, but we don't see that translating to our import for Malaysia palm oil. And if you just look at Malaysia export trend, I think just August numbers alone, we are seeing a drop of close to 20%. I think that's quite significant. But what is important to take note is that key buying countries like India and China is going into a period where they start to demand more. India, we have the Diwali festival, which is coming very soon. So obviously there's restocking activities coming. China's stocks are still relatively very low at the moment, so that will translate into higher demand going forward. Again, I think with demand weak, price is not going to inch any higher. So I think it's crucial to watch how demand is going to play out as well. So I think this year, although we see high prices, I think that really deter a lot of buying interest with current high price environment. So it's again also very crucial to watch how export is going to play out, especially coming from India and China. Now, India and China is obviously the two largest importer of Malaysia palm. And if you just look at it, I think China import has been quite abysmal this year if compared to last year. And I think that mainly attributed to government trying to rein in control in terms of price inflation. I think the government is trying really, very hard to control inflation, not pushing down to the consumer level. And actually that's try to curbing a lot of imports from overseas, and that include palm oil as well. But again, I think you just look at stock levels, they are relatively very low. Eventually, they do need to restock. And China is actually a very price sensitive market. So as long as high price environment, they probably will deter buying palm, and probably they'll buy other vegetable oil. But I think my notion and my basis is that going forward, we should see higher imports coming from both markets, China and India, for the fact that seasonality, we are coming to high buying season, and low stock piles at China port is too low, and probably they will need to restock at a point in time. India, however, on the other hand, we start to see higher imports coming in, and it's definitely higher than last year. Last year was definitely a year where India completely shut Malaysia market and went over to Indonesia. So I think this year we can breathe a sigh of relief, and India is starting to buy from Malaysia, and those numbers are starting to look quite robust. So I think coming into seasonality, in fact, we should see higher prices going forward. Now, this is to indicate the level of stock levels in both countries. So, look at China. China palm oil stocks is actually way below trend, below the average. So palm oil stocks in China is actually very low. So there will be a point in time where they need to come to the market and they have to buy more palm oil going forward. It's just a matter of pricing. Same goes for India. You just look at India stocks, it's again also below average. So we should see both markets to start to pick up buying more palm going forward. And again, it's all matter of pricing. I reckon the current price is still pretty much elevated. Therefore, they're trying their best to deter buying palm. But compared to other vegetable oil, I think palm is still quite competitive at this point in time. Now, when I say comparing to other vegetable, I think one of the key vegetable oil market that we should really focus on whenever we speak about palm oil is always the soybean oil market. So if you just look at it, I think palm oil still trade at a slight premium compared to the bean oil market. Bean oil market really took a turn. It rallied to as high as 72 cents, and it went up to right now to as low as 55 cents. Reason being is because the US biodiesel policy, which actually deters a lot of interest away from soybean oil. Now, what is important to us for take note is that the spread, despite we saw an underperformance of soybean oil is still trading at a quite big premium compared to palm. And in fact, if you look at the premium between the soybean oil and palm oil, it went as high as $600. Whenever we have such a high premium, it shows that palm oil is way underperforming. And eventually, both markets catch up. Right now, the spread is doing about $200 per metric ton. I think that's pretty much the average level that we should see going forward. And it goes to show, I think palm oil might face a bit of adjustment, or in fact, soybean oil will have a little bit more room on the upside. Now, besides vegetable oil space, palm oil is also important in terms of the price in relation to energy. Reason being is because palm oil is being used as a biodiesel. Now there's talking about green energy, the shift to cleaner fuel. So obviously, the talk of greener energy will definitely be in focus. And CPO is being mainly used as a feedstock for biodiesel. And if you have a high energy price environment, therefore it's beneficial for you to convert palm oil into biodiesel. But just last year we saw that we are in a negative price environment for energy prices. It was definitely not. There's no talks in town talking about biodiesel because with negative prices, there's no incentive at all. But now energy prices is trading at about $70. So definitely there's a lot of incentive for producers to be talking about blending palm with diesel. So I think that's another equation that we should be concerned about. If you want to look into the longer term trend in the palm oil market, it's important for us to relate it back to the energy market as well. Now, when it comes to ringgit against palm oil prices, it is quite an unusual relationship in a sense that when you have a weaker ringgit environment, normally palm oil price will tend to be stronger because of the if you cater for overseas market, which they usually trade in US dollars, you get a better bang of the buck. And when you have a stronger ringgit environment, normally you don't favor palm oil because naturally you get lesser. So right now you can clearly see that although we saw ringgit perform slightly on a bearish mode, we saw the soy palm oil price is actually quite well supportive. So it's critical for us to take again this equation and this variable because on a longer term perspective, it will have an impact. Currencies play is important for importers because that will have an impact in terms of how many quantities they are going to import. So eventually the currency team will come into place as well. Now, I just want to insert in this dollar index against the commodity price. Reason being is because there's always a lot of talks in town saying that dollar might collapse or we're going to reach record levels in the dollar index. Now, dollar index and commodities has always an inverse relationship in play, whereby if you see a stronger dollar, generally you should see weaker commodity prices. And when you have a weaker dollar, you should see a higher commodity prices. Now, I want to bring your attention to the dollar index, which is highlighted in orange. You can clearly see back in 2010, dollar index was probably doing about 70 to 80 range level. Right now, we are doing about 90 to 100 level. So indeed, if you just look at the long-term performance of the dollar index, it has indeed reached a high cycle level. So commodity index itself, when dollar keeps increasing, with the anticipation of the interest rate hikes that is coming, we probably could see stronger dollar. That could put a dampener in terms of commodity prices. So we also need to watch out in this space on how dollar index can affect commodity prices in general, because eventually that also could turn out to be in play for palm oil as well. Okay, I'm just going to briefly cover the next two slides. Now, I think weather is a very important play in terms of commodities. So if you just look at the weather model that we have here, La Nina has not been in question for a very long time. In just a couple of weeks back, we just saw the question of La Nina in play. And likely we probably could see, the occurrence of La Nina happening again this year. So I think it's something for us to take note as well. Now, I'm not going to touch on this backwardation. It may get a bit more complicated, but I just want to bring your attention to seasonality. Being in any commodity cycle, is very important for us to talk about seasonality. Now, if you just look at this price month-to-month change, you can clearly look at October, November, December is usually the strong months in CPO market. And you look at July to even September period, it's never been favored in terms of prices. So going forward, we should see higher prices in terms of seasonality. And it's important for us to take note that whether this seasonality could have a similar tendency this year. And historical palm oil price, we have reached an all-time high back in early August. Whether that will repeat again, it very much depends on fundamentals. Are we going to see lower stocks? Are we going to see lower supplies? If that's the case, we probably could revisit the all-time high again as probably later part of this year. But if we don't see that happening, likely we're going to see prices on a downward trend. Again, so you look at some of the technical perspective, the trend momentum itself is quite weak. So I think it's actually quite concerning. And yeah, so towards the conclusion, I think if you ask for a price range itself, I probably could see that palm oil prices probably could trade back above the 4,000 mark for a period of time. But if fundamentals starts to go better, I think we should see prices going to hit lower. Next key support area is actually at 3,008, and if it does break that, we should see a downward trend in the CPO prices. So I think crucial to watch on weather, and that's something that we should be very mindful of, especially with the La Nina pattern in play now. And that's pretty much on my part, and I will hand it over to Kevin for the Q&A.
Hi, David.
Hi.
It's good that you've given us so much to think about when it comes to palm oil and other commodities. And I think we have a lot of questions for this round. I'm going to put on a timer because technically we only have 5 minutes for this segment. But I would like to know for the Q&A, I think one of our friends went to slido.com that they have asked some questions. So how effective is the technical analysis approach on palm oil futures compared to the Malaysian stock market?
Well, I will give a very biased answer because trading in the market, especially in the futures market, requires me to use technical analysis all the time. I mean, honestly, I don't really apply much emphasis on the stock market for now because the nature of my trading evolves in the futures market. So I think you talk about relevancy of technical analysis in the commodities market is very relevant. Especially if you're trading this as a full-time basis, it is very relevant indeed.
All right then. Also, another very highly voted question is: would you consider? Would computer chips be considered as a commodity? And it's a big increases in prices recently. And I think a lot of people also talk about AI parts being manufactured in Malaysia as well.
Yeah, I think indeed this is a very talk about questions. I think if you just look at some of the recent wires or news wire, you can clearly see that computer chips, especially silicon and some of the key components that's used for your chips, is actually on a very tight supply. Again, I think there's multi-pronged scenarios that attributed to it. One could be a logistical issue. We have logistical bottleneck in certain parts of the world. Secondly, I think these prices will continue to rise as supply is actually very tight at the moment. Demand is just overwhelming. So obviously, I think it could. The commodities that's actually supplying to this market is actually tight at the moment. So yeah, we should see higher prices as well.
All right then. What about which commodity supply will be harder to meet the demand? Is it aluminum, copper, palm oil? This is asked by YJ, and it's got quite a few votes.
Yeah, it's an interesting question. Now, personally, I would think that the long-term narrative for copper is fabulous. Now, copper is, because we're talking about green energy, we're talking about ESG, we're talking about the shift to green economy. Copper is something that is going to be there for the ongoing period. Palm oil is on the up cycle. It is a vegetable oil. It is a much needed commodity. Longer term narrative is also still very positive. But obviously, there's always a period of up and down cycle. So currently in palm oil, we are seeing an up cycle. But I think copper has a very interesting a very interesting story and narrative going forward as well.
Thank you. I love the fact that David's going through this so quickly so he can answer as many as possible. So next question. Buying on dips would be the recommended trading strategy for FCPO right now. Would you agree?
Oh, wow. That's a very good question. I would not recommend, and anyway, disclaimer, it's just purely based on my opinion. Buying on dips for CPO can get very tricky. Now, we are entering, as I presented, we are entering into a period where we should see higher production and we should see higher stock levels. These are the periods where prices will tend to be adjusted on the downside. Whether is that an opportunity for you to buy on a dip? It may not necessarily be the case because production can continue to be high even in a low seasonal period like November and December. So it's a critical question for you to be very adaptive and for you to be very, continue to monitor some of the variables that's actually developing in the market. So I would not recommend going into deep as if you see suddenly prices adjusted. But really, I think if you look at the medium-term picture, it's still very positive. But there's a lot of variables that can change those scenarios.
Thank you. I think we have time for one or two more questions. What about other commodities pushed for Sharia compliance trading, like the FCPO? What do you think about that?
Well, I think FCPO itself is a Sharia compliance product. Obviously, definitely will be lauded if you are pushing for other products to be Sharia compliance as well, because that will create a lot of dynamics, especially in the trading community. So I think it's definitely going to be a good move if we can incorporate other commodities as well as the Sharia compliance.
All right, then. It is now 10:50, which means we have to cut off the Q&A session. But David, you're going to be joining us for the entire day, right? So I can try to spot you in the main lobby if I'm lucky?
Sure.
Fabulous. Thank you so much, David, for joining us from Iceberg X with that presentation. And David will be around, so don't you go anywhere. And make sure you join us at slido.com. More importantly, all the slides will be available after lunch or during lunchtime, because we actually have the in the lobby you'll find a category called slides, so you'll be able to download the presentation slides if you would like that. We're now about to go for a short coffee break, but be sure to come back at 10:55 a.m. as we'll be having our first lucky draw for the day. So before you go, here are some lucky draw tips. At the main lobby page, you will find a lucky draw questionnaire. We would appreciate it if you could fill in the form so you can win some amazing prizes towards the end of today's conference. Here's a clue. During the breaks, make sure you visit the booths to learn more about our partners and sponsors before trying to answer the questions. You must complete the questionnaire to participate in the lucky draw. Now, getting all the answers correct will put you in the running for some attractive prizes, including a Dyson air purifier, 2,000 ringgit worth of PhillipMaster Equity Growth Fund, and more. Do note that the lucky draw questionnaire submission will come to an end at 4:30 p.m. So head on over and check out our virtual booths as much as possible. The Securities Commission has endorsed accreditation points for this conference: CPE, CPD, and CE. If you want these points, please find the assessment tabs in the lobby, fill it up, and submit it. To ensure points eligibility, you must log out only after 6 p.m. From the beginning of today's event, you will need to stay logged in at this virtual conference. But since we're on a break now, feel free to grab some food whenever there's a break or use the bathroom. Before you go, I have some good news for you. When we come back at 10:55 p.m., we will be having our first round of easy peasy lucky draw. So if you're excited to win some merchandises, do come back at 10:55 a.m. sharp. Thank you for paying attention. I will see you in a few minutes.
What keeps you awake at night? What are your hopes and dreams? What if you could plan your life better? At PhillipCapital, we understand every client is unique. Your financial needs evolve over time. An Asian integrated financial house with global operations. We are well versed to address your needs and make your investment journey smoother. Our humble beginnings as a broker in Singapore began in 1975. Today, with more than 5,000 employees across the globe, we serve retail and high net worth individuals, family offices, corporate and institutional customers. Over 1 million clients entrust PhillipCapital with more than $35 billion in assets under management. PhillipCapital was the first to bring online trading platform Poems to Singapore retail investors in 1996. Today, with our wide range of trading platforms and mobile apps, including Poems 2.0, you can trade conveniently and gain leveraged access to global futures, forex, and bullion. As a strong proponent for investor education, we strive to keep you informed through research reports and charting tools. Seminars and webinars are also regularly held to promote financial literacy. At PhillipCapital, we also empower you to monitor your portfolio with My Wealth app. If you lack time to self-monitor, tap on the investment expertise of our professional portfolio managers. Our financial advisors will advise you on investment instruments such as equities or mutual funds available across network offices. Besides investment goals, you may have protection and saving needs. We offer regular savings plans and a wide range of insurance products to protect you and your loved ones. We can also cater to your estate needs in local and international properties through our property consultancy arm. At PhillipCapital, we believe in thinking global and acting local. Our Phillip Investor Centers and branches across our network offices are strategically located to offer you a one solution to all your financial needs. We provide solutions with API capabilities on wealth to over 100 financial institutions across the Asia-Pacific region, enabling our B2B partners and their clients the convenience to trade global markets seamlessly. We also provide advisory solutions on corporate finance matters, such as IPO, mezzanine financing, and corporate restructuring. With over 45 years of expertise growth fueled by our clients' trust, PhillipCapital has grown into an integrated financial house with a growing global presence. We seek to continue to listen, understand, and to make your investment journey smoother. We are your partner in finance.
Think palm oil is only used for cooking and baking? Think again. Bursa Malaysia Derivatives operates the most liquid and successful crude palm oil futures contract in the world that is traded by many. With an impressive track record of over 30 years, Bursa Malaysia Derivatives FCPO price has become the reference point for market players in the edible oils and fats industry. Ananda observes that the increase in the price of crude oil has always been reflected in the rise of the crude palm oil price. He foresees the crude oil price rising. To make profit out of the bullish market, he can use FCPO contract in the following manner. He can also use the same strategy for any other indications of a bullish market. How can you benefit from trading FCPO? Traders can use FCPO to gain leveraged exposure to movements in crude palm oil prices. Plantation companies, refineries, exporters, and millers can use FCPO to manage risk and hedge against the risk of unfavorable price movement in FCPO in the physical market. FCPO is Globex electronic trading allows individual and traders anywhere around the world to access all of Bursa Malaysia Derivatives products. Trade FCPO today. Contact a licensed futures broker or visit www.bursamalaysia.com. Enhance your stock trading strategies with FKLI. What is FKLI? FKLI is a futures contract on FBM KLCI, traded on Bursa Malaysia Derivatives, that provides market participants exposure to the component stocks
You guys are really fast. Look at the main screen. A lot of you are already knowing that I'm giving away some prizes at Slido. So I'm trying to go on to Slido myself. Yes, that's some gaming music. Let's put on some game music because I love games and I love game music. Especially when it comes to like a competition where you guys have to be as fast as possible. All right, so here's a clue. Now that you guys are the earliest ones to come back into this room, I actually have a couple of prizes I would like to give you. Ding, ding, ding. All right, let's take a look. Ladies and gentlemen, welcome to the first lucky draw session. Kindly take out your phone and scan the QR code you see on screen, or just go to slido.com and insert the room code PIC21 to join the lucky draw under polls, POLLS. So be sure to enter your name as per your registration. So if you enter a glamour name like Madonna, then it will not be able to work. All right. This is how the lucky draw will work. There will be a few questions that will be displayed on your screen, and you will need to answer them as quickly as possible. The first 5 participants who can answer the fastest will be the winner for this lucky draw session. So correct answer and the speed of you answering it will both come into play when it comes to us selecting the winner. The winner will be selected, well, not by me, by Slido actually. So remember to enter your name as per registration to qualify for the lucky draw. Remember to enter as quickly as you can so you stand a chance to win some merchandises. And if you are one of the winners, this is a very important part, okay? If you're one of the winners, because there's 4,000 of you, if you are one of the winners shown on the leaderboard, we have a scoreboard at the end of this game. If you see the scoreboard, there's a leaderboard number 1, 2, 3, 4, 5. If you are among the top 5, please take a screenshot of your ranking and send it to Regina from Phillip Futures, our representative at Talk to Phillip in the information counter. So if you're one of the 5 winners, go to the information counter later, press Talk to Phillip and look for Regina. If you're one of the winners, take a screenshot, send it to Regina, and then we will arrange the gift for you. First of all, we would like to thank AIA for sponsoring the first round of merchandises for this lucky draw. Now, this is all super easy. The grand prize will come towards the evening, but without further ado, let's begin our first lucky draw. Dun, 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 dun. Okay, do it as quickly as possible. Who is the organizer for this event? Is it PhillipCapital or is it Bursa Malaysia? 10 seconds left. Come on, you guys. I think there's about, I don't know, 700 of you. Come on, come on, come on. I'm so excited. The correct answer is PhillipCapital, and 100% of you got it correctly. Congratulations. The fastest person to comment is Wei Chong, or perhaps Wei Chong was the same speed as Su Chen, but Wei Chong had a higher, or he was closer to his Wi-Fi router. Let's take a look at our second question, shall we? What unit trust fund was mentioned in Mr. Ng's presentation slide? Is it Phillip Master Money Market Fund, or is it Phillip Master Equity Growth Fund? Which is the answer? 1 or 2? 3, 2, 1. Let's take a look at the correct answer, shall we? And see how many people answered it correctly. 88% of you answered correctly. It is the Phillip Master Equity Growth Fund. Congratulations. Let's take a look at the scoreboard. Desmond is now number 1, and Chia Ui Lee is now in number 2. You guys see that Desmond and Ui Lee commented both under 9 seconds. All right, they picked the answers really quickly. Don't worry if you can't make top 5 for this round, because we're doing it like 3 or 4 times. The third question for today, the first round of the Lucky Draw polls, is to claim accreditation points, which form do you need to complete? Is it A, feedback form, or B, assessment form? A or B? Pick your answer. So easy, right? The questions are going to get more and more difficult as the prizes get bigger and bigger. The correct answer is the assessment form. 88% of you got it correctly again. Let's take a look at the leaderboard. Now, if your name is on the leaderboard, please take a screenshot, okay? Our top 5 winners are, Desmond! Congratulations to Desmond Tong Jianyi, Sally, Lim Ginseng, Chia Ui Li, and MFS. Now, take a screenshot of this, and hopefully it is the same as your registration name, and then you will be able to claim a prize after this. Go to our information counter. I believe I've given you a lot of the information already. For those of you who have won, take a screenshot right now. Send it to live chat to Regina at Talk to Philip under the information counter. You have won yourself an umbrella from AIA. Don't worry, we will be having lucky draws throughout the day and more questions with even bigger prizes, one after another. Now, I'm glad that all of you are back. So we're about to begin the next session. Make yourselves more comfortable and let's get started. Our next speaker joined East Spring Alwara Investments Berhad as Chief Investment Officer in November 2018. Prior to that, Minghan was actually the Associate Director in Amundi Malaysia Sdn Berhad, where he managed regional and domestic equity portfolios for institutional clients from 2012 to 2018. His past investment experience in the industry includes Meridian, Huang DBS Investment Management, and PhillipCapital Management, where he also he started in corporate to
three parts in this session. Basically, I will highlight China's history, a bit of its history, because I think ultimately it's very important to learn about China's history. And there's a famous quote by Theodore Roosevelt saying that, if you learn from the past, you will know about the future. And I think, secondly, I also cover a bit of the recent changes in terms of the regulatory environment in China. And lastly, highlight a bit of the new fund and also probably a bit of a one-on-one session on the Asian market in China. So to start off, I think a lot of people probably do not know who is this man. For millennials or even people who are much younger who just came up into the investment industry, I think probably would not have heard about this man. His name is Karl Marx. And probably a lot of you have been wondering, who is this guy? He's actually a German philosopher in the 18th century. And back then, he was the philosopher for Marxism. And I think here it's a ideology which is very unique, because currently in our society, most of our society is broken down into mostly capitalism, and capitalism is actually mainly known as where social economic classes are broken down into your working class, upper working class, lower working class, blue collar and white collar workers. So that's currently the situation where most of our countries or economic systems are actually operating in. For Marxism, according to him, he believes that society is equal and there's no one superior class that overrules everything. So basically, he thinks that a class which is equal for everyone is a better philosophy for all. So we go into China. So here we can see that the recent meeting at the Chinese Communist Party 100th anniversary, Mr. Xi Jinping said the capacity and the strength of our economy and socialization with Chinese characters are attributed to the fact that Marxism works. So in this context, he actually highlighted close to around 12 times in his speech on Marxism and about 16 times in terms of socialist system in society. He only mentioned one time on market development. Okay, so this is the point that I'd like to highlight, that Mr. Xi is actually listening and looking back into history on the theories of Marxism. Here's a chart where you can actually see the evolution of China and the history of China. And you can see that China has gone through close to 5 presidents, from Mao Zedong to all the way to current President Xi Jinping. And throughout history, you can see that China has actually grown tremendously. So you can see this chart here shows the GDP in PPP terms, purchasing parity, over the course of close to 60 years, 70 years. So here we can see that it has grown from below $2,000 to close to currently around $20,000 in terms of GDP per PPP. And currently, in terms of the Chinese economy, it's the second largest after the US. And you have close to 1.4 billion people living in China. And back then, when the Chinese Communist Party was formed 100 years ago, there was only like 50 members. Today, there are around 90 million members in the party. So this economic powerhouse has actually grown tremendously throughout the period. And during this period, we actually can see that there was also tumultuous situations where you had, the Great Cultural Revolution. And from there on, you can see the Deng Xiaoping actually took on, and he actually developed a market-based economy for the society. And actually that started the leap forward where the country continued to see a huge expansion in economic growth. Today, I think here we have seen the rise of China, and China has actually started to see some issues within the economy. So every 5 years, the country will actually plan for its overall economic growth. So for the past 5 years, they have actually set some targets. For the next 5 years, they also set some targets. Here we can see the next 5-year target, which is basically, I've mentioned on this screen here, is basically keeping major economic indicators within the appropriate range, spending on R&D, keeping unemployment at low range, making sure the urbanization continues to benefit 65% of the population and increase life expectancy, and also making sure that they lower pollution and promote green developments in the country. And lastly, they want to make sure that they can continue this One Belt, One Road, which was started by Xi Jinping during the period, and ultimately building a peaceful China. So today, China is very different. Last time when they set the 5-year target, they actually set a GDP target. For the next 5 years, they actually removed that target. But according to IMF, they're actually expected to grow close to 8% GDP this year, and subsequently 6% on the year after. So I think here we have to know that China is recalibrating its growth story and actually making sure that they plan for the future. So on this chart here, I just want to highlight, the future. It's basically a chart that says that 没有共产党就没有新中国. So it says that basically there is no communist Chinese party, there will be no China, new China. And this slogan is actually very well perceived by the party, because ultimately the Chinese government have actually learned from history, and they have actually seen the collapse of the Soviet Union, which disintegrated, and the communism in that country actually move towards more democratic. So I think here we have to understand that in the current situation, China is making sure that they continue that this philosophy Marxism works, and the ultimate key players will be led by Mr. Xi Jinping, who actually thinks that he needs to continue to recalibrate the economy. So you can see that he actually has put in some certain measures to make that economy continue to run its steam. So looking a little bit on Mr. Xi's background. So if you go back into history and read his profile, he's actually a son of a revolutionary. And during back then in the Cultural Revolution, he was actually, his father was actually banished to the countryside. And he actually had to grow up quite poor and actually started to work up his ranks throughout his life, and actually pleaded with the party to join the party and actually tried to get a membership. And he actually pleaded a few times before he actually got membership to the party. So it was a very interesting profile of his living experience. And today, I think China is actually correlated to most of his living experience back then. So I think here we actually have to monitor this man closely, because ultimately he is the leader of China and he will be actually taking us forward in the next 5 years. So we come to the session where we talk about China fine-tuning its economy. So here, just to sum up the points here, we are at a significant moment in the history of Chinese economy and capital markets. So after a decade-long journey to eliminate absolute poverty, Beijing is actually shifting its priorities to balancing growth and making sustainable a society where society equality, data security, and self-sufficiency is the priority. The top economic community is actually vowing to encourage people to do more philanthropy and making sure that the economic income distribution is olive shape. So the shape of an olive, as you can see, is actually a middle it's bigger in the middle side and actually smaller at both ends. So here we see that the Chinese policymakers will actually probably use taxation, social security, transfer payment policies to tackle this unreasonable income. Because in the context of China, China has actually grown so far so big, and 1% of their population currently owns like 35% of their wealth, and the top 20% earners owns like 20 times much higher than their current bottom poor. So I think here there's a big disconnect in terms of, Chinese being a socialist country and they are having mostly a capitalist type of market. And currently, I think this regulation that they're actually putting in place is to make sure that they fine-tune the balances in between and making sure this balanced approach is actually addressing the poor and also people who are at a disadvantage. So going forward, we have actually seen that China regulation on fintech, big tech, after-school tutoring will be actually ongoing, and actually this has been started since earlier this year. Slide 8 here says basically slogan signaling. So what has happened during this period? We actually heard common prosperity, 共同富裕. It's basically China's agenda now, the main agenda by President Xi. He actually mentioned this speech close to 65 times in the course of this year, and it has actually started to pick up last year. The reason being is actually very simple, because there's a lot of unhappiness, especially the working class people who are finding difficulty getting good placements in universities and also getting good jobs. So I think there's a lot of issues starting to crop up in the society. So now it's time to actually recalibrate this economy. And back then, when this common prosperity term came out, it actually came out first during Mao Zedong's time. So it's actually nothing new. And going forward, and then past Mao Zedong, Deng Xiaoping actually came in and actually changed the economy to be more market-based. And actually that drove the leap into making a lot of people rich, and especially mostly the tech companies very rich. So in this situation here now, I think that they actually realized that it's time to make sure that the economic prosperity is shared among everyone. So also to put into context, I think over the last few years, I think there were like 81 people mentioned in the Forbes 500 list who are actually billionaires, and actually those 81 people actually are from China. So what has happened? China earlier in the year actually started to crack down. So we have actually seen that China fined Alibaba 2.7 billion. Tencent was also fined. Recently, we have the news on gaming, Tencent's gaming, which actually has to restrict minors from playing video games to 3 hours a day over the weekends. And I think this is nothing new, because over the course of the history, China has always come up with measures to make sure that there's always check and balances for their society. And I think this actually is a good thing. It makes society more safer. And also overall, we know that the government is in control. So this is what I think will actually favor investors going forward, because China is actually making sure that the country is safer for investments going forward. From this chart, you can actually see the overall situation for China over the course of the years. There have actually been going a number of crackdowns. So we can see during the mining periods, the booming periods in the green bar for mining. Subsequently, there was also crackdown on illegal mining without licenses. And then we also had, dairy products, which, there was a scandal in milk scandal. And that's why they actually started to make sure that they have to have policies in place to enhance food safety. And subsequently, during President Xi's tenure, he had come out with the anti-corruption campaign, and he actually to regulate, party members to this 8-point regulation. And also we had also gaming and also drug type of regulations after a booming period. So there's nothing new. So basically, my point here is that even though the crackdown and the regulation for internet technology companies is nothing new, it's actually after a boom period where there's always some challenge. As a result of all these measures, you have actually seen, over the course of history, they have actually managed to eliminate with the fantastic chart here from 100 million in earning much more than the bottom quintile. So here we calculate its economy, and actually the share of wealth is actually distributed evenly to the rest of society. So the chart down there, the line down there, the blue line down there should actually start to increase, and also subsequently to the middle quintile. And how are they going to do this? They are actually looking at 4 key areas of policy. Firstly, they are looking at social risk, national security risk, and a manufacturing sector that they would like to have. The last situation where they had were curbs in place to reduce China design chips. So now going forward, China is actually going to be more self-reliant, making sure that they have the capacity in place so that they do not face any shortages in the future. Software to strengthen cybersecurity, where you had DT listing in the US, and they had party officials in terms of their movements, whereabouts, track on their data app. So that's why I think now we had these checks in place for software developers. And lastly, Financial risk and environmental risk are the other two risks which the country is actually monitoring closely to make sure that there's no debt blow up, especially in the bond market. In this case, recent news was the China Huarong, where the Chinese government is actually coming in to bail out the company. So these are the few measures that they actually announced. So there are a few implications. So mostly are negative for this, for example, the tech companies in terms of cybersecurity. And in terms of the platform companies, it's actually, for example, they have to make sure that their user data is protected, and it's also likely to be negative for internet platform companies. Data security too, because data security should be enhanced, and it will also be negative for all these data-rich tech companies. So the snapshot here, you can actually see that it's basically mostly affecting tech companies going forward in China. So tech companies going forward probably will see a slightly slower growth environment because they are actually focused on doing their social welfare redistribution. Following that announcement on tech regulation crackdown, we had a huge sell-off in the Chinese market. So you can see here the Chinese stock market actually took a huge tumble, and it was the worst performer this year on a year-to-date basis. So here we can actually see that it's just behind continental Europe and Japan. However, if you drill down closely into the respective China markets, actually this sell-off was actually concentrated in the internet and education sector, and also the China-listed American depository shares in the US. The Islamic A-share index and the Chinex index in China is still in a positive territory on the year-to-date basis. So don't be fearful of the news that China was on a huge sell-off, because if fund managers like us, we actually drill deeper into the data, and actually we find that actually there's pockets of opportunity coming from China. And in this case, we actually noted that the A-share market in China and also the Chinex index in China is actually remains quite attractive for institutional investors like us. And also, if you look over the longer term, over the course of 2010, 2011, the course of 10 years now, China actually continued to provide strong returns for investors over the medium to long term. Which is an equity dynasty fund, and it was launched back in 2010. And that fund actually, over the course of 10 years, actually also have achieved close to 180% return over the course of that period. My third part of this presentation now will cover the A-share market, because I've just highlighted the A-share market was in a positive territory on a year-to-date basis. I'm sure a lot of you might be wondering why. So here I will just give you a basic 101 primer on A-share market. So the A-share market, stocks and shares are listed on the mainland, basically on mainland China, and they are actually categorized into two, which is listed on the Shanghai Exchange and the Shenzhen Exchange. So the Shanghai Exchange operates the main board and the science board, which was established in July 2019, and the Shenzhen Exchange operates the mid small cap board and the Chinex. And also this both exchanges offer B shares, which are actually targeted at foreign investors. And this trading platforms basically offer investors the differentiation between buying into offshore and onshore. And in this instance, we can actually see that in the onshore market, they're actually more focused on technology innovation, which are mostly main board companies, and also comprises a lot of these traditional stocks. And the China Asia market offers investors a broad access to a lot of these traditional companies, which very niche, bio, defense, semiconductor, which are not available in the offshore market. And if we go down deeper and look into the breakdown of those two exchanges, so on the left-hand side, you can see the Shenzhen Composite Index since 1990. You can see that the index is mostly driven by the blue line. It has grown quite significant. The blue bar there, which is actually driven by financial. Com index is actually mostly heavily driven by financials. And then if you look at the second largest compounds, you can also see actually very prominent. So here we can actually say that the index on the manufacturing sector of China And I think this is very important because changes in this sector compositions also result in a shift in the China's economic structure over the long term. So what happens now when we see going forward where China is actually reducing its dependence on tech, I mean, most probably, make that the manufacturing sector becomes stronger, we will actually see the green bar actually rise even further. And looking at the situation where China was earlier on learning from the German economic model, where German SMEs and also German technology companies and also the SME market is actually fairly huge over the course of history. They want to make sure that this SME segment actually continues to lead the economy. So here my point is to make sure that we monitor this closely and know that China is actually shifting its growth profile in terms of identifying areas of growth within the subsectors of their structure. This is also a similar breakdown, but it's in percentage form. You can actually see that the Shenzhen Com is around 15% driven by industrials and also financials, which I mentioned, close to 28, compared to, for example, your MSCI China, which consumer discretionary is about at 33%, and consumer discretionary is actually including your stocks like your tech platforms like your Alibaba and your JD.com, which were affected by the recent crackdowns in China. So that's why the MSCI China this year actually underperformed, while the onshore markets actually outperformed. So going forward, you actually see that if you want to invest in China, you have to pick your selections very carefully. And here, you make sure you pick your selections within the sectors with less regulation. A bit on valuations for A shares in the Asia market. As you can see that the Asia market actually took a correction earlier this year, and it's actually now back to its mean for PE, trading PE, and also similarly for price to book ratio, it's also at its mean. While we break down the sector in terms of the valuations, we can actually clearly see that the ones which are actually trading on the upper line, which, for example, here we can see auto, the dot which is actually on the upper line is actually trading at the higher end of its PE valuation. So we have auto and electrical equipment, two sectors which are fairly expensive in this case, while the other sectors are actually trading in, relatively speaking, lower end of the line. So here we want to say that most of the Chinese sectors in the Asia market is actually quite cheap, and also there's attractive valuations for those sectors, especially in the manufacturing sector. So you can see that even in light manufacturing, it's in the middle there. You can see that the line is actually in the middle. So it's not really that expensive. So going forward, if you want to pick stocks in the Asian market, you have to pick stocks clearly in the sectors which look cheap or is driven by economic policies which actually drive their growth. Similarly, for price to book ratio, here you can see that electrical equipment is trading at the high upper band, and also to a certain extent your machinery equipment, and also non-ferrous metal because of the recent rise in the commodity prices. So make sure that we identify the sectors correctly and actually put the money where it is, where the growth is at. In terms of foreign ownership, here we want to point out, foreign ownership in the Asian market is slowly rising. Actually started to rise since 2013, and now it's close to 600 billion foreign ownership of the Asian market. And in terms of the equation here, you can actually see that they own close to 12-13% of the space is actually owned by foreigners. And this actually can only increase further because as China opens up its onshore market, we expect this number to further increase. And China, being the second largest economy in the world, will definitely have to open up because they are expected to overtake US by the year 2028 as the largest economy in the world. And we expect that if that happens, we could actually see the Asian market fully open to foreigners. Here is a snapshot in terms of the pie chart, and you can see that most of the foreign ownership is actually in the H share space, close to 77%, while the A shares is only 30%. And the reason being is because A shares there's a curve in place where they only can open up to 30% foreign ownership. So I think going forward, we actually expect the Chinese market to further expand further, and actually the opening up of this quota to allow more foreign investors to invest in China. And to compare this with other markets, for example, Korea. For Korea, foreign ownership in Korea is close to 30%, of the market, and in Taiwan, it's close to 40% of the Taiwanese stock market. Here, we can see that onshore China A share is only like what 9% owned by US citizens, and foreign ownership by 13%. So it's fairly small. Another a few more charts on the A share market. Here we can also want to point out the A share euphoria that happened back in 2015, where the stock market was so speculative, and it was driven purely because it was very domestic driven. Today, the stock market is actually very different. It has actually a lot of institutional investors and domestic fund managers involved. So the market actually has stabilized somewhat. And you can see here from the left-hand chart here, you can see that even though the CSI has continued to rise over the last 4 years, the new investor registration continues to remain low. So there's no more euphoria, jumping into the stock market like back in the 2015 period. And also back then, you have seen on the right-hand side there, there's a lot of stocks going limit up. This year, we have seen the stock market gone up so much. I mean, last year we have gone up so much, but we didn't see a lot of stocks going limit up. So it clearly shows the Chinese market has really started to change in terms of demographics, where now it's more institutionally owned compared to previously. And if you compare that in terms of tracking the data for margin financing, so here you can see margin transactions outstanding back in 2015 is spiked up because a lot of retail investors jump into the market. This over the last 3-4 years, we've actually seen that it's a gradual increase. So investors now are taking a more cautious approach when investing in the market, and I think a lot of investors now are more savvy in terms of investing in the market, and they also know that debt is a two-edged sword, where you take margin debt could actually benefit you on the upside, but also could be very painful when you go on the downside. And it ties back to earnings growth. So over the course of history, we can see that the earnings revision breadth for the A-share CSI 300 has continued to rise. Currently, that's 80% of their companies have actually reported positive earnings breadth. That means that companies listed in the A-share market continues to report positive results, and that's actually driving the interest into the stock market. And why should we buy A-shares? As I just mentioned, China is the second largest economy in the world. So here we see on the left-hand side here, US is the largest market cap across global exchanges. Imagine China being the largest economy in the world by 2028. I believe the Chinese market cap of stocks in China will actually start to rise, and probably equal US or even overshoot them. And here we also can see on the right-hand side here, in terms of the market velocity and turnover, China is the one of having the highest market turnover and the velocity compared to the rest of their peers in the stock exchange. So it shows that China is actually slowly growing, and actually probably will soon outgrow the United States in the future. In the last slide on this China A-share primer, it's basically talking about the index providers. As you know, index providers play a major role in making the benchmark. And here we have seen that over the course of period, index providers has actually started to increase the weighting of China A-shares on their benchmark. So they started with 2.5% back in 2018 for MSCI and the FTSE. And they slowly increase, and by 2021, they expect this should be growing up to 25% of the benchmark, and for MSCI is up to 20% of the benchmark. So here we can see that it's a clear sign that China will want to slowly open up, and the index providers are actually started to increase their stake. So to conclude, here I think there's always a disconnect, because we as foreign investors, we always see the headline news and we always feel fearful that there's a lot of changes going on in China. But I think the domestic investors gradually believe that the Chinese economic recovery is on track, and they expect earnings of companies to remain stable. And there's always the opinion, there's differences between industry regulation and also the style of investing in China. So we have to identify the regulation that is actually in place to make sure that we pick the correct stock picks in China, identify the sectors that we actually allocate our money. And going forward, China is actually going to ease. That's the key message here. China is going to ease the monetary policy. Unlike the US, which is actually probably going to tighten end of the year and next year, China is easing policy. So they actually had the RRR cut in July, and they're also going to ease further policies going forward. And second half should be actually more easing environment compared to first half. And lastly, in terms of navigating the regulatory changes, I think fund managers here have already done this, because you either avoid this sector altogether or you choose to invest. So as fund managers, we actually believe that we should not ignore China, and there's always opportunities to invest in China. And following the trade war in 2018, I think China's strong push towards self-sufficiency in manufacturing will play an even dominant role going forward in the society. So that should conclude my presentation, and I leave you with this chart, which shows President Xi holding the dragon of China. So watch this man closely, and I believe this man will take China to greater heights in the next term. He's actually running for his third term next year. So he will probably take China to greater heights, and I believe that China will actually bring more prosperity to their citizens, and also more wealth to the country. Thank you all.
Thank you so much, Ming-Han, for that wonderful presentation, from the storytelling to the background to China and a lot more. Now, Ming-Han, I hope you're ready to answer some questions.
Yes.
Perfect, because I think we have 4 questions on the screen right now. People can join in at slido.com to ask more questions, or you can try to catch Ming-Han throughout the day. However, the first question is, with China's regulatory concern and US market at an all-time high, uncertainty and uneven recovery across emerging market, where should we invest? It's a very loaded question, isn't it, Ming-Han?
Yes, indeed. Back in 2019, I also attended the PhillipCapital talk, and I was talking about China. I think back then in 2019, I said I was also telling a story of China and something of the past. Really, people know about it, so there will not be any forward. It's more concerning is actually how they implement it. And I think the Chinese regulators know that they need to actually have proper communication and make sure that these policies are properly regulated and implemented. And while the US is at all-time high, I think here we believe that the US is going through the boom cycle, right? So now I think when they are actually going to taper, probably end of the year, and also next year will probably raise interest rates, there will be probably uneven recoveries, definitely going into emerging markets. But bear in mind, the US will not taper so fast, so it's empty for the markets. We have actually seen a few instances in the past, back in 2000.
So I guess this would answer the second question as well, whether it is a good time to invest in China, since you mentioned that it's always great to invest in emerging markets. So let's move on to the third question. Current China policies in restructure economy landscape, is it strategic in shaping China's leading world economy role?
Yes, because China going China is actually developing its soft power policy to be reshaping China's leading world economy. On the irony is that Afghanistan for now, but China is actually going in a big way. So here we can actually see a very big differentiation between two giant powerhouses in terms of soft power policy.
What about your current view on the new Beijing Stock Exchange?
Okay, so the new Beijing Stock Exchange, I think I understand Xi Jinping is going to launch a stock exchange for the SMEs. I think this is the third SME stock market that they want to basically grow. I think they have already seen the growth of all these internet companies doing so well. I think now it's time for all these SME stocks to actually take the lead, because China is actually learning from the German economic model, where current manufacturing output from China is around 25%, and in terms of the German economic output coming from the manufacturing sector is at 18%. It's quite similar actually. And I think going forward, the Chinese economy will actually need the SMEs to sustain their economy going forward. So with this stock exchange, it will allow a lot of their companies will require funding to actually tap onto this stock exchange.
Now, someone asked, how do they participate in China A shares? And does Eastspring Investments offer any product solution in that space?
Oh, this is a very good question. So on next Monday, we will be launching a new A-share fund. If everyone is interested, as I just gone through the A-share primer with everyone here, I think you could actually talk to your investment managers, also your relationship managers to or advising and the share market going forward will be playing a key role as portfolios, and also to look back in history where we actually launched the Equity Dynasty Fund back in 2010. And if you believe that we could actually make money for you, and over the course of 10 years, that fund actually made almost 180%. Going forward, this new fund purely on Asian market will also do the same.
Oh, wow. What do you think about the US, whether it will have further capacity or the idea to damage Chinese participation in the global economy like how it did to Huawei?
Good question. So yesterday, I think Xi Jinping and Biden actually had a phone call. Both of them were talking about, mostly reconciliation and also to collaborate in terms of making sure that they do not want to challenge each other again, like how they did in the trade war, which, I slapped one country with a trade sanction and you slapped me back with trade sanctions. I think that's very damaging because ultimately we have actually seen what has happened, especially in the semiconductor space, where now we have a huge semiconductor shortage because corporates actually had to cut back or actually ban production because they were supplying into certain countries. So I think here, going forward, we see that, there will be a reconciliation between both US and China and making sure that both of them can grow together.
That's good to know. Now, one last final question by anonymous commenter. Is there any focus shift into ESG-related initiatives from Chinese policies, given the more visible impact of climate change, or do you think China will keep its 2060 net zero plan?
Yes, because I think ESG initiatives has taken off in a big way in China, where they are actually developing most of their sectors to be more environmental friendly. So I think environmental pollution, for example, with regards to your coal-fired plants in the Chinese environment, which is damaging to the environment, they have actually started to cut back on those type of investments and making sure that the financial sector do not lend this money to this type of sectors, to make sure that they comply with the zero emission carbon targets that they have set in place. And also we have seen the rise especially in the EV space, where energy vehicles will be a more prominent role. The Chinese government also is encouraging more companies to develop this type of technologies to be focused on environmental friendly. So I think definitely the Chinese ESG space will start to pick up, and there will be more news flow coming from that area.
Thank you so much for joining us today. And that was our special guest from Eastspring Alwara Investments, Berhad. Thank you very much once again to Mr. Tan Ming Han.
Thank you, Kevin. Thank you, everyone. Take care. Take care.
No worries. All right, ladies and gentlemen, next up, we would like to call upon Christopher Kok King Fai. He's the head of equities investment Kenanga Investors Berhad. Christopher Kok King Fai has joined Kenanga Investment Berhad, and he actually joined in January 2014 as a portfolio manager, and currently has more than 12 years of experience in financial markets. His responsibilities include portfolio management, macro strategy, as well as research coverage on selected markets and sectors. Previously, he was with Meridian Asset Management, where he was also involved in managing local and regional portfolios. He began his career with Am Investment Bank in the equity capital markets department, where he worked on numerous deals, including initial public offerings, follow-on equity offerings, secondary placements, and underwriting risk assessments. So, joining us today with the topic of equity market outlook phase transitions, please help me welcome Mr. Christopher Kok.
All right. Good morning, everyone. Thanks for tuning in today. Hopefully, we can actually meet in person the next year. but this year I think we'll do it online. And thank you so much, for your support, and for those who have been with us, throughout the years. And for those who are new, let me just give a brief introduction. My name is Chris. I head the equities department at Kenanga. I think a team of 13 of us look at equities, and another 8 of us look at fixed income. So I think today I'll bring you through the market outlook globally in 30 minutes. Hopefully I can do it. Let's go on to the next slide. The next slide. Thanks. Okay, all right. So the first thing we're going to talk about is the global market outlook. Second, I'll talk about Malaysia more in detail, and then I'll go through a bit of our key fund performance. Okay, next slide. And the next one. All right, just a bit of review here before we start. I think last year, we saw developed markets performing strongly, and I think this year is a bit of the same story where we saw, US market definitely outperform. I think the S&P 500 is up double digit right now. I think it's up about 14-15%, together with, I think, the European countries as well up quite strongly. If you look at the MSCI Asia ex Japan, I think it's down slightly. I think this is end of August. I think mainly due to the declines in China, which I'll talk about later. I think locally also we saw, I think the local markets do quite badly in the first half. I think there was a strong rebound in August on the back of reopening. But I think overall it's still down about 1.6%. I think mainly due to the renewed lockdowns. Okay, next slide. I think certainly a key reason why there's been a divergence in terms of outcomes of markets is actually the COVID situation. And we see that developed markets have been quicker to vaccinate and thus ease restrictions. Whereas countries in Asia, I think we have adopted previously a more cautious stance, focusing more on preventing the virus from spreading and actually lockdowns. Therefore, the vaccination was actually a bit of slow to ramp up. I mean, not only in Malaysia, but in ASEAN as well. I think even in countries like Taiwan, Korea, I think it has been a bit slow. So if you see this chart on the right, I think the top few countries that have reached a high rate of vaccination is the UK, almost 61%. This is end of August. I think now it's progressed more, definitely. I think the US was about 51%. So we see that actually the lower amount of restrictions have enabled the economy to rebound faster. If you look at the next slide. So the next slide just shows you the index of actually the mobility restrictiveness according to a survey done by UBS. And if you look, if the line on the chart is actually moving lower, that means it is actually less restrictive, or basically it's more open to economic activity. So if you look on the chart on the left, in developed markets, I think the US and UK have one of the easiest in terms of policy restrictiveness. So you can see that, because there are lower amount of restrictions there, that the economy could actually bounce back strongly as well. But if you look on the chart on the right, which is emerging markets, so you see, countries like Malaysia and Vietnam, which appear high on the list. So high meaning that, they are quite restrictive in terms of what can and cannot be done. So therefore, the economy has also taken a bit of impact. I think no surprise there. All right, next slide. Okay, so let's go to the 3 main regions in the world, US, Europe, and China. And let's talk a bit about, what the outlook is for the next few months at least. So I think here at Kenanga, we have quite a solid process in terms of analyzing macro and both stock specific. Of course, we don't really talk much about our individual stocks, but we talk more about the macro outlook. So the macro outlook, I think, of course, I won't go into too much detail in this short session, but I think the key to note is the rate of change in growth and inflation will tell you a lot about, what to expect in the upcoming months for US. So US, we saw recorded a strong 2Q GDP of actually 12% year-on-year growth. Of course, this is mainly due to base effects, because last year was the worst of the lockdowns in April and May. But of course, this year is a strong rebound of that. But nonetheless, I think the second point is that we still see a more than a 6% year-on-year growth for both third quarter and fourth quarter of 2021. So actually, even after coming off the very strong high level, we still see a very robust growth for the US for the remainder of the year. And I think that's what's driving the strong performance in the market as well. So what are the factors that are supporting growth in the second half? I think the labor market is continuing to improve. I think as we see that economic activity continues to pick up, more and more people join back the labor market, and also businesses are starting on a new capex cycle. Capex meaning capital expenditure. So basically, when businesses see that activity is picking up, they start to invest more. They start to expand their business, and this will actually become a cycle that leads the economic growth even higher. Of course, there's a bit of a slight hiccup, maybe this quarter due to the resurgence of the Delta variant in the US as well. So I think the market has been a little bit choppy towards August in the first week of September, but I think overall growth remains strong. Next slide. So I think moving on from growth, I think inflation also is still quite high. I think in July we saw inflation remain high at 5.4% year on year, and so this could be a major determinant in the path of interest rates going forward. So I think the chart on the left just shows you the probability of interest rates hikes, and if you look at the bar chart, it's actually moving up towards 2022. So I think not to worry yet. This year there is a very low probability, or rather, we don't see a chance of a rate hike this year, but more likely into next year. And even next year is actually looking at the end of next year, which is November and December, and even that is actually still below 50%. So if you look at the last point, if we look at the market implied probability, this is based on the market survey, the probability of interest rates hike in the US next year is still below 50%. So it's not a foregone conclusion yet, although we do think that there could be maybe one towards the end of the year, right? Okay, next slide. So that's the USA for you. I think in the EU, the European Union is the next to catch up. I think we see that the European Union has been slightly behind the US in terms of a few months of growth, and I think that they will also be another one to experience a strong rebound going forward. So third quarter growth for 2021, we see it coming in at 3.9% year on year, and fourth quarter moving on to 5.2%. And if you look at the table on the left, actually, I'll read out to you, the first quarter of 2022 growth will reach a high of 6.8%. So for the European Union, a very mature region, a very, how would I say, slow growth kind of region, reaching these kind of numbers is actually something that is on a historical high. And we think it could be the next region to actually do well as well. So I think PMI is still in an expansionary territory, although there's a bit of a slight slowdown in August. I think the Delta is also, of course, a bit of a slowdown in terms of manufacturing, and there's a bit of a supply chain shortages as well. But key to note is that I think we think that this will be temporary. All right, on to the next slide. So in the next slide, we always talk about growth, then we move on to inflation and interest rates. So in terms of inflation, interest rates, and monetary policy, we think that the European Union is still supportive. In fact, if you look at the chart on the left, they are one of the most supportive central banks in the world, expanding their balance sheet, I think, very rapidly compared to the Federal Reserve in the US and the Bank of Japan. So I think the European Union has been pumping a lot of money in the economy as well. They came up with their emergency bond purchase program, injecting 1.85 trillion euros over a period of 1 year until next year. And they also have mentioned that they will not really hike interest rates until inflation remains well ahead of 2%. And actually, the interest rate right now in Europe is actually negative 0.5%. So I think the policy support is still very supportive. And the chart on the right shows you that inflation, although it's expected to increase in the second half of this year, but it's actually forecasted to come back down again in the first half of next year. Right? The next slide. So there you have it, a brief review of Europe and USA. So now let's move on to China, the third key region in the world. I think China, we saw a slowdown in the first half. Bear in mind that actually China was the first out of the COVID crisis, and therefore they actually started to slow, beginning of this year. So I think another reason why they slowed was because of the actually policy tightening by the Chinese government. So we saw a few key things. They have tried to control the amount of credit growth in the economy. I think the Chinese government has actually been concerned about the high debt levels among corporates and among the local governments as well. So they've actually put on the brakes a bit, and that has actually impacted growth. We saw a bit of a focus on structural reform, meaning that they want to actually focus more on clean energy, electric vehicles, and reduce the amount of quote unquote dirty energy that they produce. So we saw also a bit of a policy tightening there. And also number 3 is the anti-monopoly actions in the tech and internet sector, which impacted a lot of the key big Chinese internet stocks, which they want to actually reduce the amount of monopoly power that they have. But actually, of course, if you look at the motives of the Chinese government, I think we can understand why. After all, I think they do want a society that's actually more equal. There's actually been a lot of concern in China about the inequality. and certain parts of society being left behind as well. So I think that they do have a rational reason why they're doing it. They're not just anti-business overall. Of course, that this will actually impact some of the investors. So I think in terms of sequential GDP growth on the chart on the left, we see that it has peaked at 18% in the first quarter of this year, and actually is going to come down to 7.9 to 5.6 to 4.7 in the fourth quarter of 2021. So I think the fourth quarter of this year will be probably the bottom of growth, and I think the next year probably China will start to pick back up again. Next slide. But actually, the key thing to note is that policy is going to ease going forward, and I think this was mentioned by Ming Han in the previous section as well. I think if you look at the policy, they have actually cut the reserve requirement ratio once already. So basically, this just to keep it simple, this ratio shows the amount of money that banks can actually lend out. So they have reduced it, and actually this has resulted in actually, I think going forward will allow credit growth to slowly bottom out and rebound going forward. And also we see that normally fiscal spending normally picks up in the second half. So overall for China, I think it's a slowing growth, no doubt about that, policy tightening, but I think things are starting to change slowly. So policy moving to an easing zone and probably leading into a recovery economy in 2022. All right, next slide. Okay, I think I'll skip to the summary. So the summary is that growth is strong across developed markets. But I think, of course, we're slowing down a little bit from the peak growth, but I think it's not to worry. But because growth is still on a very high base, which is more than 6%, which will still be supportive for markets. And I think the key to watch is whether the Federal Reserve tapers or not, or reduces the asset purchases. For now, they seem to indicate a willingness to tolerate higher inflation. So we think tapering could be more of a December issue or more of a 2022 issue. So I think overall equities probably in the period of consolidation, but with a slight upward bias. This is global equities I'm talking about. All right, moving on to the next slide. Okay, moving quickly to Malaysia. So Malaysia, let's spend some time here and talk about what's happening in the economy, the vaccination and reopening progress, the strong external sector, and the bottoming out of foreign shareholding. Those are the key trends that we see. Okay, next slide. Okay, so Malaysia, I think we all know what's been happening. I think the lockdowns have impacted us badly. I think the GDP growth from initially 5 to 6% now revised down to 4.4%. So yes, we have a bit of hiccup in terms of our economic recovery. But then again, I think what is missed by most people is that actually the manufacturing sector is still very strong. First half, I think manufacturing sector grew about 15-16%, whereas exports grew about 23%. So don't forget that I think the strong global recovery in the US has actually contributed to a strong export performance, and this has been helping our country as well. The next slide. So reopening will drive the recovery going forward. I think this was at the end of August, but I think right now the full vaccination has increased from 46 right now to I think about 51%. I think by end of this month we'll probably reach about 60, and the next month October towards 70%, which will enable us to move to I think phase 4. So we do see a strong recovery for Malaysia in the fourth quarter of this year. Next slide. And don't forget that actually, despite the negative news, I think there is, aside from exports, which is positive, there's also the fiscal stimulus, which supported domestic consumption. I think it's the Pemulih is the 8th stimulus package, so we have done 8 so far, and the most recent one is 150 billion. Of course, the bulk of that is through the EPF scheme. Next slide. And also continue to look forward to the 12 Malaysia plan on the end of September, and also budget 2022 by the end of October. Next slide. And on the monetary side, I think BNM will maintain a accommodative policy. So we saw that last week, I think interest rates was maintained about 1.75%. I think this is still fairly supportive to the economy. Next slide. As I mentioned, I think exports is the bright spot for Malaysia. And amidst all the negative news, sometimes we may miss that there are certainly pockets of opportunity. I think if we see that E&E exports, the semiconductor supply chain is doing really very well on the back of the stronger performance in US and Europe. I think our rubber products continue to sell well. I think CPO is at above 4,000, which is one of the all-time high in recent years. and even oil has rebounded back towards the $70 per barrel. So actually not all is bad for Malaysia. I think exports is very strong, up almost 26% for the first 7 months. Of course, the second half will be slightly slower given the base effects, but still I think overall exports could be mid-teens to even high teens growth for this year. Next slide. So I think this exports and also the recovery domestic, the domestic sector will lead to strong earnings recovery for next year especially. I think this year earnings recovered already quite strongly for the first half, but I think the bulk of the growth will come from the upcoming quarters. So 2021 actually the EPS growth is about 45%. Next slide. And the last theme I want to talk about is actually low foreign shareholding. So I think as of recent years, I think foreigners have been selling the Malaysian market. I think the first 8 months of the year, there was actually net selling of 4.5 billion. But actually in August, foreign investors returned to the market and bought about 1.05 billion of shares after being net sellers for the last 18 months. So I think the way I see it is more of a glass half full kind of view, where that foreign investors have already mostly exited the market. And if actually things start picking up and start turning positive, actually they could return to the market and be actually a positive contributor instead, because their holdings are already at almost all-time low of about 20% of the market. You can see that in the chart on the right that ever since 2007, this is already one of the lower levels. Moving on to the next slide. Whereas ringgit, we think will remain range bound. I think ringgit will be supported by the strong exports. So the current account is still showing good surplus. Second quarter, we saw a surplus of 14.4 billion, or about 3.9% of GDP. So I think that's still supporting the ringgit, although of course, the political uncertainties did impact the ringgit a bit in August, but we still see, recovering post the, installation of the new Prime Minister. Next slide. Of course, the risk in Malaysia is always political uncertainties. We have a new government right now, but I think going forward, we need to see it continue to be stable. There's still debate on whether there will be a vote of confidence or not. And if it passes that, at least then we can see some concrete policies being put in the upcoming budget. Next slide. Where are we on valuations? I think there's been a strong rebound in August, but I think valuations are still below the mean. I think trading at about 15.6%. 15.6 times, which is lower than the average of 16.4 times. Right. Next slide. Next one. So I think overall, given our strategy, given what's happening in the global situation in Malaysia, what is our strategy? So I think for global, the growth outlook is still strong. And I think developed markets could grind higher despite high valuations. However, could see a bit of volatility towards the fourth quarter as tapering starts to take place. I think in ASEAN and Malaysia, I think recovery will pick up in the fourth quarter, especially on the reopening of the economy. So where are we? We adopt what we call a barbell investment strategy, where on one side of the barbell, we see that it's the recovery themes, where we like themes like the economic recovery, we like the commodity plays, consumption. These are the reopening and recovery plays. And on the other hand, we still favor the growth and mega trend companies. I think these are structural trends that will continue to drive growth regardless of the economic environment. I think we see key trends like 5G and actually AI driving the need for more and more semiconductors. Imagine that the amount of data that produced in the world today has actually increased by, I think, 3 to 5 times compared to just a few years ago. So the amount of data produced in this year, I think, is close to, if I remember correctly, it's about 5 times the amount of data produced just a few years ago. So I think the amount of processing power required to process this data has led to a boom in semiconductors, and this will actually benefit the supply chain that's located in Asia, and also Malaysia is a key beneficiary of that as well, which is why we invested in some of the tech companies here. Aside from that, I think trade diversion, multinationals setting up shop in Malaysia to diversify away from those countries that are impacted by the trade wars, and we also see the renewable energy trend, the EV trend, also benefiting a few key component suppliers. So I think we keep on one hand the recovery team, and on the other hand the structural growth team will actually contribute to overall good portfolio performance. Next slide. Okay, so that was covering both the global and the Malaysia side. in 30 minutes. But okay, let's now talk a bit about key fund performances. I think for those of you who have been with us through the years, I think we've done a good long-term track record. If you look at the 3-year, 5-year, and 10-year return, I think it's all 20 to even 70% for 3 years. So I think that's pretty good. I think year to date, the first half has been a bit slow, but I think it's recovering strongly in August. And for Malaysia, we see Q4 being strong as well. So I think some of the funds are doing okay. I think Asia was impacted a bit by the slowdown in China and also the regulatory tightening. But we see also China starting to bottom out towards the fourth quarter. Right. Next slide. Of course, our key fund highlight is the Kenanga Growth Fund, which has always been our flagship fund, 11% to date. Next slide. And this is also one key thing to highlight. I think for us at Kenanga, we have had good track record in terms of our Malaysia and also our regional funds, Asia focused. But now, we also are launching the Global Growth Fund and the Global Islamic Fund. So I think we believe that investors should have a diversified portfolio, both of having global equities, Asia and also Malaysia. So, not being overly dependent too much on any one region at any given point in time. So I think the global fund will help investors diversify, especially to developed markets like the US, Europe. So for funds, we target at least 70% allocation to developed markets, and especially the US. And I think the US will be one of the key country holdings that we have in the global fund. I think US is the home to one of the most innovative companies in the world. We see the Apple, Google, Facebooks, Tesla, all coming from the US. And I think, key, iconic companies of our century will continue to come from US. So I think, investors can get exposure to those companies by buying the global fund. Of course, just to note that this is actually a fund relaunch. So it was relaunched from a previous funds where, we believe that the previous funds was not adding so much value to investors. So just bear in mind that the previous performance track record for these two funds is no longer relevant. And actually, these funds started in July and should be measured from July onwards. Okay, so just a brief comment on our newly launched Global Growth Fund. All right, I think that wraps up my presentation, and I think I can move on to Q&A.
Hello. Hi, Chris. Can you hear me?
Yes, I can hear you good.
Perfect. In that case, let's take a look at some of the questions we already have. As trade war of US and China persists, what do you think? At the end, will US or China lose more? What is the impact to countries who have to choose side and or those who have to stay neutral? What do you think the market gain is going to be? I think this is like 4 questions in one, by the way.
Yeah, of course, this is a very complex question and something that is going to play out over the next decade. So in terms of investors, I think, it's hard enough to forecast a year going forward. Forecasting 10 years is going to be even more complex. But let me just give our view. I think what's going to happen is that I think the US and China will move into 2 different spheres of influence. So there's going to be a block, a US block, and there's going to be a China block. And the US will have its allies and its own ecosystem, and the China will have its own allies and ecosystems as well. And I think actually this could also be an opportunity for companies. Of course, in the short term, there could be some disruption in supply chain. But I think what's going to happen is in the long term, companies will actually have a backup plan. So let's say if I'm a MNC, I have factories in China. So aside from having factories in China, I will also relocate some of my supply chain to have factories in, let's say, Mexico, or even in Latin America, or even in the US itself, which is what we see companies like TSMC, Samsung doing. They're actually relocating some factories in the US to actually diversify their source of production, to have both in the US and also both in Asia, just in case there is any further disruption. So actually, this is an opportunity for, let's say, companies in Malaysia that's actually supplying to these companies, because now they have two subsidiaries to supply to instead of one. So they supply to the China side of the supply chain, and also they supply to the US side of the supply chain. So I think, aside from viewing this negatively, I think there are also a lot of opportunities that are opening up. A lot of companies are opening up new factories in the US as well. A lot of Asian companies as well. So I do think that although there could be a sort of bifurcation in the global geopolitics, where it centers around the US sphere of influence in the Western Hemisphere and the Chinese sphere of influence in the Eastern Hemisphere. But companies can actually play both of these regions to grow even more than before. Right.
Okay. What about the inflation in the US market? Will it be a dampener on the equity markets in the US?
Yes. So I think inflation, overall, as long as inflation doesn't reach high levels for a sustained period, it would actually be okay for the equity markets. What do I say sustained period? Meaning the period of more than 1 year. So right now, the Federal Reserve view is that inflation is transitory. So even in the recent Fed minutes and the Federal Reserve speeches, Jerome Powell has said that inflation is high, but it's mainly due to base effects and a bit of supply shortages that could be temporary. So we will have to see whether it lasts longer for a period of a year. So for right now, I think the inflation right now, the market is still able to digest that. But then again, with markets, there's also always a way to profit from this. With high inflation, I think this has benefited commodity companies. Companies that produce metals like aluminum, food products, even timber. CPO is high, oil is high. So I think inflation is actually also a play on commodities, and actually by investing in commodity companies, you can actually also take advantage of inflation. Right.
I think we've got so many interesting questions here. For example, Ting Mi Ting is asking if you see the capital development in India in the next decade going through any tremendous changes.
Yes, I think India is also one of the key regions that will see very strong growth in the next decade. I think the market has done very well this year. Of course, with emerging markets, economies tend to go through, up and down cycles. But I think overall, it's one of the most dynamic regions in the world. I think it's the youngest population. Compared to China, India is a bit of the opposite in terms of demographics. Whereas China is an aging population, I think India is still very young. And I think because of that young dynamic population, we'll still see strong growth into the future.
All right. Now, COVID-19 is going to remain for a while as a real risk. How do you factor it into the portfolios that you manage?
Yeah, sure. So I think this is a good question. I think we saw the Delta variant impacting markets a little bit in the last month. Excuse me. But I think, as I highlighted in my strategy, I think a key way to manage this is by having a barbell strategy. So on one hand, we have the recovery plays. On the other hand, we have the structural growth plays. So structural growth, like e-commerce, the Internet of Things, I think this was actually boosted by the COVID pandemic and will continue to do so. I think the more and more people have shopped online, and we see that their habits have stuck, despite some reopening. Of course, it won't be the growth rate won't be as high as before, but we still see a change in behavior, which actually benefits all these e-commerce companies. So they are actually COVID beneficiaries, and they still continue to have some exposure to those in the portfolio.
Mm-hmm. Now, with the expanded increase in interest rate next year, will REIT still be a good investment, long or mid to long term?
Yeah, so actually REITs, you have to be a bit more, in a rising rate environment, typically is negative for REITs. But of course, there are a lot of nuances to this. It depends on which REIT and what kind of REITs. So if we look at, let's say, REITs like, let's say, shopping mall REITs, or let's say, office REITs, that they have pricing power. So those that they can actually raise their rent, or economic activity will actually contribute to rising revenue for them. So for them, they are able to mitigate the rise in interest rates. So for those that are unable to do so, then those will be negative. So I think you have to look at it on a case-by-case basis for REITs.
Mm-hmm. Now, did any of your funds invested in China Evergrande real estate company? If so, what is your plan to mitigate the default risk?
Yeah, so fortunately, we do not have China Evergrande. But of course, I think China has seen a lot of policy changes in the last 6 months. I mean, to be fair, we were also impacted a little bit in the internet space. But then again, I see that I think this will be a temporary issue, both in Evergrande and also the other policy cases. I think what's happening in Evergrande is that I think the Chinese government is allowing some of these defaults to happen because they want to impose market discipline on the participants. So I think in the last decade, a lot of these Chinese property companies went out on a borrowing binge, and started, increasing the debt levels to unsustainable levels. So I think the Chinese government is that, okay, we need to send a warning to the market. Of course, they do not want the market to crash as well. I think Chinese government, the stability of the market and to investors and also the population is very important. So I don't think they want to actually tank the market, but it's more of giving a warning to investors that you shouldn't be too over leveraged in the property space. And in terms of the internet space also, it's more on just ensuring that everyone gets their fair share. So I think they're not anti-business, and probably this will start to recede in terms of end of this year and into next year, right?
Mm-hmm. Now, one of the most voted questions on Slido.com is: will the prosperity policy limiting entrepreneurs' innovation and business? Will the prosperity policy limit entrepreneurs' innovation and business development?
Yeah, so I think it's something that's been debated a lot. I think what China's government's motive and intention is they want a fair share of the economic pie to benefit everyone. Because we see, in China, they have this a trend right now they call lying flat. What they mean is that a lot of people, especially in the big cities, they're sort of given up on trying to progress in life because of the high property prices. I think it's just out of reach for them, and they've decided to just quit their job and just migrate to the country and just have a simple life. So I think a lot of people have been a bit disillusioned about the high cost of living in China. So I think the Chinese government is responding to that, and I think they want to ensure that the wage rate is enough to support everyone's livelihood. And I think that that's a fair intention. But as into whether they are anti-business, I don't think so. I think they still want to develop the private sector, and private sector has been the engine of growth for the last 20 years. So I think yes, you will have some short-term impact in terms of the businesses. They will have to adapt to the new rules. But I think overall, over the long term, it could be a good thing, because as the wealth is more evenly distributed, consumers will have more purchasing power as well. We saw that in the US that when you actually pay your workers more, when the wealth is shared more equally, the overall economic growth tends to be more dynamic in the longer term as well. Yeah.
Now, I'm pretty sure the next question is not very easy to answer, but I'm sure someone like you, Christopher, will get it all the time. I'm sure people ask you this question all the time, and I want to see how you answer it. So, which sector and country is the best to invest in right now?
Yeah. So right now is the key word in this question. So
yeah,
you invest, we have the 1 month time horizon, 3 months, and of course a few years, and I'll attempt to answer that in that way. So if you ask me right now, if you ask me 1 month horizon, we still think developed markets is on an uptrend. I think the US has been doing well, but will continue to do so because growth is strong. Now, if you say it's a 3 months horizon, I think that the Malaysia will start to rebound in the fourth quarter, and also the Chinese market will start to bottom out and rebound. And if in the longer term, in the next 6 months, I think emerging markets will start to catch up a bit with developed markets. But I think rather than trying to time the short-term 1 to 3 month kind of movements, we always advise investors to have a diversified portfolio. You have some in Malaysia, you have some in Asia, you have some in global and developed markets as well. So I think you benefit overall from the growth on a long-term basis. But of course, in certain environments, you can adjust your allocation up and down a little bit. But to probably be all in on one region or all in on one sector at one point in time, I think it's a bit dangerous. Unless you are an active day trader.
Another question that's got a lot of votes. I think we're down to the last one, if I'm not mistaken. The current market sees an increase in equity price, bonds, junk investment prices. Why do you think this is happening? Speculations or QE?
Yeah, so I think overall we've seen strong growth in all asset classes, and actually I think this is a function of two things. Both growth and also liquidity. I think growth has been very strong. We saw actually, last year impacted by COVID, but this year growth has been roaring back in the US. I think, the full year GDP growth for US is 6%. And I think for the largest economy in the world to have such a high growth rate, 6% normally is for small emerging markets, but we see even the US achieving that kind of growth rate, meaning that the underlying economic fundamentals, it is very strong. And in terms of liquidity as well, I think you see that because of the COVID crisis, central banks have actually pumped in vast sums of liquidity into the market. I think the Federal Reserve is still buying assets to the tune of $120 billion a month. Every month they're buying $120 billion. So, the amount of money being pumped into global markets, interest rates all-time low. I think US close to zero, Europe even still negative. So with the low interest rates, I think money goes to assets which offer growth definitely. So that's the two main reasons that's driving markets. I think sustainable or not, I think we have to look at the data as things evolve. I think growth is still strong right now. Liquidity so far no signs of pulling back. But as the government starts to withdraw liquidity, then maybe the market could go through some volatile periods. Right.
All right then. Oh, thank you so much, Christopher. Now, Christopher is the head of equities investment, Kananga Investors Berhad. A round of applause for Christopher Koing Fai for joining us today.
Thank you so much. Thanks, Kevin.
No worries.
Bye.
And thank you. And that was Christopher King Fai. And now we actually have a surprise. Ladies and gentlemen, this is the second lucky draw session. I hope you're getting ready for even bigger prizes. So take out your phone and scan the QR code indicated on the screen, or go to slido.com and insert the code PIC21 to join the lucky draw. Now make sure you enter your name as per registration. And if you are the winner, in the final screen, we have a scoreboard. If you are the winner, you're in the top 5. Make sure you take a screenshot, okay? If you take a screenshot of it, you can send it to Regina from Phillip Futures, our representative, who is available at Talk to Phillip at the information counter. I repeat, if you're one of the winners, you have to head on over to the information counter and tell them with a screenshot of the leaderboard, okay? The scoreboard will come out towards the end of this lucky draw. So I hope you guys are ready. Without further ado, let's begin our second lucky draw. Dun, 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 dun. Are you guys all in? 300 people? Okay, we can do 300. Should we wait for a bit? Should we give them 1 minute? Oh, it's starting now. Participants will be credited with the following accreditation points after completing the assessment: CPE, CPD, CE, or YRG, JIK, OZR. What is the answer? You gotta be quick, and you gotta be accurate. The correct answer is CPE, CPD, CE. 99% of you got it correctly. Congratulations. Let's see who got the correct one fastest after our third question. Let's move on to the second question. Where should a participant enter to answer lucky draw questions? Is it the lucky draw page or auditorium room page? Come on, come on, come on. Earlier, someone answered in less than 4 seconds, which I think super impressive. And the correct answer is chang, 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 the lucky draw page. You guys thought this was a trick question, didn't you? Congratulations to the ones who answered correctly. Let's take a look at the third question. What is the theme of this conference? New government trade war, geopolitical risk, where are we heading to? Or is it road to investment, turning the corner? You guys know the answer to this one, right? I feel like I've mentioned it. The correct answer is road to investment, turning the corner. 81% of you got it correctly. Let's take a look at the scoreboard. Congratulations to our top 5 of this round. This is the second round of lucky draw. Congrats to Lau Lei Yi, Wei Chong, Rif D, Wong Chun Hong, and Tan Siu Ling, JD Tan. Make sure you take a screenshot if you're on this scoreboard, top 5. Take a screenshot on your phone right now and head on over to the information counter and tell us that you are the winner, okay? If you don't take a screenshot and if you're not paying attention to my instructions, you may not be able to remember this. So take a screenshot of your rank, send it via live chat at the information counter to Regina, our representative, who's available at Talk to Phillip in the information counter. Ladies and gentlemen, it's actually almost time for lunch, so a couple of important announcements before I let you go. At the lobby page, you will find a lucky draw questionnaire. We would appreciate it if you could fill in the form so you could win some amazing prizes at the end, at the grand lucky draw. Here's a clue. Make sure you visit the booths to learn more about our partners and sponsors before trying to answer the questions. You must complete the questionnaire so that you can participate in the lucky draw. Now, getting all these answers correct will allow you to go to the end of the conference. At the lucky draw, you'll be able to win some prizes. Let me check, because right now I want to see if I can win the prizes so I could join you for the lucky draw. And that includes Dyson Air Purifier, 2,000 ringgit worth of Phillip Master Equity Growth Fund, and a whole lot more. Do note that the lucky draw questionnaire session will come to an end at 4:30 p.m. The Securities Commission has endorsed accreditation points for this conference. And if you want these points, you got to fill up the assessment form of the lobby. So fill it up and submit it. So to ensure points eligibility, you can only log out at 6 p.m. today. Don't go anywhere. Do not turn off your computer. Do not log out of Zoom. You will need it all the way till 6 p.m. today to get your accreditation points. And in a quick look ahead, the conference will resume at the in an hour. So let's aim for 12:20. Sorry, right now, let's aim for 1:20 p.m. Let's aim for 1:20 p.m. Yeah. Let's be back here in 50 minutes at 1:20 p.m. Here's a quick look ahead. We're going to be breaking everything after this into 3 tracks. In breakout room 1, the session is called Riding on Winning Strategy. Breakout room 2, the session is called The Return of Asia. And in breakout room 3, the session is called In Search of Alternatives. For more information, head on over to the main homepage and browse around. So for those of our friends who just won the top 5 of the second round of the lucky draw, congratulations once again. Please head on to information counter. You are going to win something from PNB Investment. The merchandises include lunchbox and a cooling towel. That sounds great. So I hope you guys continue to take part in the lucky draw because the prizes get bigger, and then we give away some Dysons. So let's take a lunch break. I'll see you back here. I will be in the main room. There'll be 2 other concurrent rooms at 1:20 p.m. This is Kevin Chong. I'll see you in 15 minutes. Enjoy your lunch.
What keeps you awake at night? What are your hopes and dreams? What if you could plan your life better? At PhillipCapital, we understand every client is unique. Your financial needs evolve over time. An Asian integrated financial house with global operations, we are well versed to address your needs and make your investment journey smoother. Our humble beginnings as a broker in Singapore began in 1970. Today, with more than 5,000 employees across the globe, we serve retail and high net worth individuals, family offices, corporate and institutional customers. Over 1 million clients entrust PhillipCapital with more than $35 billion in assets under management. PhillipCapital was the first to bring online trading platform Poems to Singapore retail investors in 1996. Today, with our wide range of trading platforms and mobile apps, including Poems 2.0, you can trade conveniently and gain leveraged access to global futures, forex, and bullion. As a strong proponent for investor education, we strive to keep you informed through research reports and charting tools. Seminars and webinars are also regularly held to promote financial literacy. At PhillipCapital, we also empower you to monitor your portfolio with MyWealth app. If you lack time to self-monitor, tap on the investment expertise of our professional portfolio managers. Our financial advisors will advise you on investment instruments such as equities or mutual funds available across our network offices. Besides investment goals, you may have protection and saving needs. We offer regular savings plans and a wide range of insurance products